for all of the clients. And so as of Monday, fully available to all clients at Schwab and all new prospects, obviously, who want to come on and join the firm and jump on the platform. Surrounding that, we've got 70 plus educational courses, articles, computer-based training, the best service teams in the business with our trade desk. We like to talk about traders supporting traders. And then obviously all the products and things people want to trade on the platform. And so really proud of sort of that holistic value proposition that's now fully available at Schwab.
So basically, if you were on Thinkorswim, you're not losing any of the capabilities that you had. You're now gaining access to other things. And basically the same goes if you were on the Schwab side. You now have the Thinkorswim in front of you, the platform that has been there. You still got your Schwab products. I mean, essentially, it's sort of a one-stop shop now.
Bingo. You hit the nail right on the head, Oliver. And then in addition, you know, a lot of traders are also investors. And so for the Ameritrade clients that are coming over, access now to the broader depth and offering that Schwab brings is something else that makes us really, really excited about what's coming here. Really that holistic value proposition for traders and investors all in one place, one-stop shop.
The commitment from an education standpoint that a lot of people know, and then of course I like the point that you mentioned of the long term from the Schwab side. I mean, there's kind of a lot of day trader mentality from the TD side, and then now you've got this more kind of macro long-term investor. What is kind of the feedback and the value proposition, I guess, that you now consider the comprehensive platform is offering to that sort of holistic investor?
Yeah, so I mean, trader is really important to Schwab, and I think I want to hammer that point home. You know, roughly 20% of revenues come from the trading world, and you know, when you're talking about 21 billion in revenue in 2022, that's a big number. And so the commitment is absolutely there. And what we like to talk about are the platforms, the network, all the educational content. Not just for traders. We have millions of what we would consider sort of non-traders or sort of investors that are interested in following the markets, that are interested in accessing great news programs like this, that want to access charts, that want to use research, and they do all of that via the platform. And so really what we're talking about here is full-on continuum from your novice traders or your active investors, as I like to call them, all the way through to your most advanced traders who want to use the most sophisticated back testing functionality and other features within the platform. So it really runs the continuum, Oliver, which is really what we're super proud of.
Love it. Hey, you mentioned the support and the for traders, kind of by traders, which as I learned to trade when I first joined here 6-7 years ago, that was something that also stood out to me immediately as I was in quite a few chats. Maybe some I didn't want to be in, left some options positions open a little too long, but I think it's an important point to come back to for a sec, just because if folks hadn't been using those tools before, I mean, they're really incredible, frankly.
Yeah, no, we completely agree, and it's an excellent point to hit on. You talk about self-directed traders, and that doesn't mean trading alone, right? The service team's second to none here. We talk about that traders here for traders, the experiences designed by traders, your service and support are via traders, whether that be sort of the risk management elements of it, whether it be sort of initial guidance or feedback on how to place your first trade. Again, along the full continuum, it is all there. But mission critical component of the value proposition is to have best-in-class service when you need best-of-class service, right? Whether that be, when you're just getting started or as we get into an option expiration period, whatever that reason may be, having that service is such an important component of the value proposition.
All right. Hey, my platform looking at still green here on my desktop. James, where's the blue?
So we're still there with both, right? Fully available on Schwab, fully available for the Ameritrade clients that have yet converted. We will be finalizing the last two waves of conversion of the Ameritrade clients here in the first half of 2024, at which point we will go all blue, Oliver.
Okay. And then right now, if people don't have either trading platform that they prefer, I mean, if they don't have Thinkorswim, when I type it in, as I was mentioning coming into the segment, it takes you to a different landing page, right? If I go to download Thinkorswim now, I'm arriving at Schwab, but it's all there. Follow the prompts. It's not hard to get to.
We try to make it as simple as possible. Absolutely. You log into your Schwab brokerage account on the web and access under the trade tab. You can access all the full suite of Thinkorswim platforms, whether you want the web-based platform, whether you want the desktop download, and then if you want the mobile app available in all your app stores across iOS and Android.
All right. Great stuff, James. Thanks for the update. Appreciate it very much.
Thanks, Oliver. Pleasure to see you as always.
Yeah, absolutely. All right, congrats. It's a pretty big effort. And of course, for those of us that are, we have our allegiances, but now that it's all together, it's going to be fun. Long-term meets the short-term investor, and now we take a holistic approach, just like we do here on the network, trying to combine the macro big picture with the active trading around earnings and short-term analysis. Thanks to James Castilius there for taking us through it. Head of Trading Services at Charles Schwab. Let's come back, talk some stocks here at the opening bell. A few earnings to get through. We'll be right back.
You know that tech stock we talked about?
Good morning. It is October 18th. We're going to be watching the stock market, trading stocks, options, futures, day trading the SPY, daily options. We're looking at GME, AMC, GNS, whatever. Market just opened. Thank you guys for being here. Hopefully you had a good evening and good morning so far. Sub up, like up, comment down. Happy Money sticks around. Twitter's at Happy Money YT. Follow us on there as well as our Discord server. Link for both those are in the description. And up here, I'll put a link for Discord also in chat. Morning Guts. Guten Morgan. Thanks guys for your likes. 3 likes and we just had the bell 2 minutes in. Let's see, SPY is down 0.48%. Morning reps. Reps. Doing well, man. Hopefully you are doing good as also. AMC is flat. Got GME's down 0.5%. RAD is now trading on OTC. Up 30%. Sold off like 60% though when it came into OTC. Okay. GME did break that $14 there this morning. Got a bunch of penny stocks up this morning. Up on my watch list. Ones that once were not. Ones that have been for a while. That's crazy just to look through and see all these that used to not be penny stocks. Phase. Newegg, Birds, Brad. Oh. GME's juicy at these lows. Even more juicy if it gets to single digits. Juicy, juicy, juicy. I'm gonna delete yesterday's markings. Market's just kind of setting up, I think, today for PAL, so trying to be very patient. Might not be much of a mover today. Might be a range bound type day. Green candle there on SPY. I guess we did break the... No, we didn't. These rad calls I have are for liquid now. Let's give me a wide spread. Is it? Okay. Yeah. The AI down 0.25%. This is down 1.5. Funko's down 3.25. First Solar's down 1.5. Let's see, Fisker's down 2. Jones down 2. Roby's down 1. Lucid's down 1.4. Lanter pretty much flat. Things held up really well. And Rad's down 2% now. Maybe down 1.9. Fly back down to VWAP. Got Infobirds, Vulcan, Newegg. The green one's on my list. Of course, Liquor's at the bottom of the list. Down 10%. Woof. Woof is down 4.3. Run's down 4.3. It's nice. My liquor position, it's lost so much value that 5-6% on it dropping doesn't even matter anymore. It's gone. I trade with Weeble also. I don't have really any money in here right now, so I haven't been, but yeah, trade with Weeble. Barbecue shares disappearing from Robinhood? I haven't heard that. You held them on Robinhood, now they're just gone? What's customer service said? Doing the VWAP chop. AMC a little pump there. Low there on SPY. Generax down 2, JetBlue's down 3.5. Teladoc's down 2.5. Run is down 4. Dish is down 1. Beyond down 1.9. And Space down 1.5. Deemed worthless. Robinhood customer service said they deemed the shares worthless. I don't have Robinhood or barbecue shares, so I don't know. That's what I'd be curious on what they said. Tickers down 10. Oh, airlines are still getting wrecked. United's down 7.5. They have earnings. Yeah, they did. That earnings this morning, they beat on EPS, beat on revenue, and it's dumping. Because of profit forecasts, so bad guidance. Interesting. All the airlines are down. Caterpillar's down 4.5. Today we do have pre-market. We had housing starts and building permits. And 12 we have Waller speaking and Williams also speaking. And at 2 there's the Fed beige book. Little VWAP tester on SPY. Grab some calls. Close them at the top of that channel, or some at least. A little profit up there. If we get so let's see. Yeah, 10:30 we have crude oil, bunch of commodity stuff. go. Pins is down 3. In that range. Bot? Oh. Yeah, I guess you just have to wait and see. Hopefully you're not having to battle your brokerage for some equity in some other company. Ready green? Not necessarily. I'll trim the top of this channel if we break it. Might add. Went in a little heavy, which I don't like to do this early in the morning, but I'm just thinking about yesterday, and that first trade was but again, today could be kind of a setup for tomorrow, so might not get as good of a trading day as yesterday. Could have even scaled into these balls. Usually moves pretty fast in the morning, so I usually have time, but I had time today. Where is up 1.3. Visa and Cosmo up 1.25. Build a little inverse head and shoulders there. See if we stay off this channel. Yeah, if you're holding barbecue shares in a brokerage and they've just disappeared, I would probably call them and keep them on the hook. You need to have some kind of record that you're holding those shares, whatever happens with them. Screenshots, all that kind of stuff helps. Just keep it documented. VWAP's come down a bit. There's a break on VWAP. Green candle. Sell a couple of these. In case we don't break. Ah, that was my only opportunity. Could have closed all of them. See, we could still get a break here. That was the problem. Breaking fidelity, man. Yeah, once I've made enough on this account, I'm gonna remove some over to TD, and then probably transfer my whole fidelity account to Webull. Warning sickness on the market. GME is down 1.5. Building a lot of liquidity here. Up DBS. Little flush on SPY. Too low there. It's just to that support line. What's that from? Plays back, I guess. Oh yeah, that low of that day. 10-11. Microsoft, everything else. Yeah, it was the small caps that were rallied the SPY yesterday. Yeah, Nvidia, everything was dumping yesterday. Except for small caps. What's GNS doing? It's down 2.5. I climb back up to VWAP. Probably close to more of these calls at the top of this channel. Wait for confirmation. Wait for a break. We're jumping back in. Closing a couple there. Okay, buying them back. Close a couple at high day. Right there. We made a little cup here. Maybe form me the handle. Or we just are chopping in this range. Put a stop on the rest for break even. I didn't get out of enough at the high day. It's so fast. Oh. Crazy old brokerage. Skipping over my stops. Okay, I stopped out of the rest. Down to VWAP. through VWAP. Closed like 20%. Should have closed half. Oh well. That is chop.
Around why there's been price cuts. Is it to spur demand? Is it for other reasons, costs coming down, what have you? There's a lot to focus on. Much of this will be in the conversation with Elon and team.
Okay. And, I've had mixed feelings on the price cuts. At first, it kind of seemed like, all right, it perfectly fits the macro narrative of a slower China and a waning consumer. But now that we've seen how much the legacy automakers have struggled, not just with strikes, but like literally recalls and stuff for some of the main cars, it feels like maybe I'm kind of gravitating to the camp that maybe it was a sly move by Mr. Musk to kind of take advantage of a moment in which he's still the dominant producer of EVs, cut the prices, get people locked into his car, before GM or Ford can get to them. I don't know. It's kind of, I've been kind of drifting that way over the last several months, I got to be honest.
Yeah, I tend to agree with you. I would say that I think this is a longer plan. I think this has always been the plan for a company like Tesla. I mean, Elon not that long ago posted sort of his business plan from back in the mid-2000s of make an expensive car to make a slightly less expensive car to make a more affordable car, etc. And I think that this is all a part of that grander plan. I do think there's something to the monetization after the core product. I mean, we've seen Apple really lean into that in terms of its services business. But like anything, I don't think it's is as cut and dry or black and white as it's to spur demand or some other reason. It's probably a little bit of both, Oliver. They have seen market share deteriorate as more and more competitors have come into the space. So I think they're conscious of that as well. Looking to make a car that is desirable at an affordable price, I think, is the goal for every one of these automakers.
Okay. All right. So in terms of what's going to move the stock, number of deliveries, profit, bottom line, cash flow type stuff, top line revenue. What do you think's the key metric here this season? Because it's important to remember that for Tesla, it's changed over the years, right? Like it used to be just pure delivery numbers. Then for a while it was profit and it was cash flow when they first joined the indexes and stuff. And now I'm not so sure, to be honest.
I think since we have an idea, the delivery front was a little bit disappointing. I think it slipped 6.7% on its last read to 435,000 for Q3. Don't think that's going to be as much in focus. It's going to be gross margins, Oliver. If you made me pick one thing, we've read so much about the price cuts. We've read so much about demand waning. But really the question comes down to, how have they managed cost? How have they been able to weather the fact that they've lowered prices? If they've been able to do a little bit better on the margin front than the street's anticipating, I could see an upwards move in the stock.
Okay. All right. Thanks, Alex. Good look here at what's going to matter this afternoon. Post-market coming up. So let's do some trading. Joe Teagay joins us, portfolio manager of the Rational Equity Armor Fund. What do you think, Joe? Going to go with the uptrend off the lows or the downtrend off the record for Tesla? Because depending where you put those goalposts, man, you got totally different perspectives on this stock.
Yeah, and we're really kind of consolidating the past few quarters here. We got what I see is a bit of a wedge. We're on the lower end of that range. I'd see the higher end of that range on the wedge pattern being about 270. For me, that'd be my price target and an upside move. I think Alex mentioned this. He touched on this. The market maker move is around 5%. You go back historically on Tesla earnings, they move. Stock moves over 7% on a report. So I think that's an attractive spot for me. I'd like to look at options to play this name. I can also think of this as a stock replacement strategy, but I'm looking at the just expiring this Friday 255-270 call spread. It'll cost me $4.30. And, bit of a max profit of $11 close to if we do trade above 270 by Friday.
Okay, so this is short term by Friday. I mean, you're looking for earnings pop.
Looking for an earnings move. Again, only risking 430. Now, if I were to hold the stock through earnings, yeah, we could see a 5% down move. I'd be looking at a $15+ loss. So for me, this is a good way to take some risk off the table. Just play it through earnings. We're probably going to get a move following earnings. Historically, that has been the case. So yeah, I'd be looking at that. If it does go lower, I'll have a little bit less risk on the table. I can buy it back lower, or if it does trade higher, I'm participating to the upside.
Okay. So the call spread 265 and 270, or is that 255?
255 and 270. Yeah.
Gotcha. Okay, that makes more sense.
$15 call spread, a little closer to that than money. I think 270 for me is that price target. I mentioned that wedge. I mentioned maybe a declining trend line. I think it would be hard to get through that spot. If it does, that would be great for Tesla. It would be great for the spread. I'll reach my full profitability, of course. But I think that's my price target. I'm not looking for it to go to all-time highs after this number. Just looking for that market maker move, like Alex was talking about, to the upside. And if I get that, I think I'll be very happy.
What do you think is going to be the determining factor for whether or not this stock can get a bounce? What's the market going to key in on?
Yeah, so it probably will be looking at sales. We've seen some disappointing sales from some of the other EV makers lately. Musk has been on Twitter talking, maybe mocking some of these sales from Lucid and Ford lately. Yeah, I think that price cut might mean that some of their loss from their competitors is going to be Tesla's gain in terms of raw numbers going out there. Again, but sometimes with Tesla, it is the unexpected. These conference calls can go either way, and sometimes things we don't have on our radar is what moves the stock.
Okay, yeah, that's true. All right, and I like that you've got your eyes on the same trend lines and basically betting that it stays within them, doesn't break to the downside, and then more likely to bounce but not break through that kind of longer-term downtrend.
We are on the lower end of that trend line. Yeah. I do think we do break below. I do think we could see a big move down. Again, that's another reason why I like options on this play. If I were to hold the stock through this earnings event, I'd be looking at potentially, a $20 loss very easily on just like a slightly negative report.
All right. So a little Tesla bullishness with a Friday expiry. Short-term trade. Joe Tigay. All right. Looking for a strike to hit it right down the line and get on base by Friday. All right. Thanks, Joe. Appreciate it. Portfolio manager of the Rational Equity Armor Fund. When we come back, this might be a little Tesla conversation, but we're going to be talking a lot of shorts. Of course, there's still plenty of Musk haters and Tesla doubters out there, but plenty of other companies and themes that investors have been betting against. The team from S3 Partners, which specializes in short data, is going to tell us what everybody hates.
Okay, I still chopping around here. Want probably a break of the high even to consider it long. And there you have it. But continuation or back to chop. Almost got in here on BBBYQ, but I didn't like how choppy it was. I maybe need to exit all of them right here, I don't know. Yeah, wait for a better entry. AMC up 0.25%. Down here a bit. Back into the chop. We're actually going to have some continuation to the upside.
So you'll see the big institutions kind of piling into certain names so they have negative future impact on their earnings.
Okay. Now, you have another way to assess shorts, which is how crowded they are. What is that definition? Remind us and tell us what's crowded.
Sure, and this kind of takes into account market cap. So what we're looking at is total dollars at risk. I want to know how many chips. I want to know how much money is being put on the table by short sellers. Then I want to know how big of a percentage of the market cap. How many? So I do want to know whether it's 3%, 5%, 20%, because that tells me it's crowded based on its market cap. Then I want to know is it how's the days to cover? A lot of short sellers get out of a name if it's really hard to cover the stock. So it's taking me 6, 7, 12, 15 days to cover my position, cover the short position in the market. I'm kind of scared because I can't exit my trade without having price risk.
Yeah.
And lastly, I want to know if there's stock loan available to borrow a stock. Sometimes you might have only $200-300 million worth of short interest. There's no stock borrow left. There's no more short selling left. So it's crowded.
And where is that happening the most?
We're seeing Fisker, Beyond Meat, Sirius, Lucid, Sava Pharmaceuticals, I mean AI, C3 AI. These are all really, really crowded shorts.
Wow, interesting. Okay, so they're betting against some of the EV trades, betting against some of the hot winners in AI. Okay, what else jumps out to you in the data? Anything we should know? Where are the minefields? Because that's kind of the way I think about this. You know, like crowded shorts, that's kind of a minefield. If, you get wrong place, wrong time, that could get ugly.
Exactly. And you know what? There's another thing we produce, something called a squeeze risk. So we're trying to tell our clients what stock is squeezable. Basically, the only reason you're going to get squeezed out of a stock is because you're losing money. So I want to know what shorts are, where shorts are getting pummeled recently. What really was interesting this morning when I was looking at my data was that retail stocks, particularly the stocks dealing with clothing, Gap, Abercrombie and Fitch, Foot Locker, Hanes, Victoria's Secrets, Five Below, American Eagle. These are all squeeze risks. So you know what? There might be a pop if these shorts start getting hit some more with higher stock prices. There might be a pop because we're going to see buys to cover in this sector.
Fascinating, because those stocks had been doing really well the last few months, and I even commented a few times on the show that it was kind of peculiar in a way. So maybe we've got some answers there where there's too many people betting against it and they're getting squeezed. I mean, you got a fresh new high for American Eagle today out of nowhere.
So you know what? You're going to see shorts leaving because you get smacked around pretty hard. You're going to exit your trade. Someone's going to tap you on the shoulder telling you, let's find something else to short.
Yeah, because American Eagle ain't it.
Yeah, exactly.
All right, cool.
Yeah, we're getting
Always
some
love
puts
the
there.
insight. Thanks, Eeyore. Appreciate it.
Take care. Nice being here. Thank you.
Absolutely. Mr. Dusanowski is managing partner. That's 3 partners. All right. Know who's betting against you because the squeeze potential is real, and so are some of those crowded shorts if they don't come true. All right, Chartmaster, when we come back, we're going to preview Lamb Research, LBS, and Discover Financial.
Here, maybe some of the day.
3 very interesting stories.
Still kind of grading as if it was choppy, since it is choppy. So taking profits quick. Some there. Take some there. Stop on the rest. See if we make it to the bottom of this channel. There's a new low on SPY. Take some profits there.
To kind of get alarmed there. Potential support beyond that, we had this small gap right here, 580s where we opened up. That could be another spot to watch. To the upside, 660. about where we had some highs here, about where we've got a little bit of a volume node right there. And that would also be representative of a move beyond that downward sloping trend line as well. So that would be the point of an upside breakout.
Okay, so it seems like right now pressure's on for Lamb to maintain what it's already achieved and not let this slippage in the last few sessions send it below those moving averages, below the trend line.
Fleshy.
But generally, if you expand beyond like the last week, it still is pretty good, right? Even the last 2 weeks, you get the RSI picking up off the oversold area, and just a lot of dip buying that's happened in this company at basically every turn the past year. So something would have to definitely break, it seems like, in terms of some of the expectations, which are already kind of low, as you point out to us, Jenny. All right, let's switch gears. Let's talk Las Vegas Sands. I know that this one is particularly interesting to you. I feel like it is, too, because it has this China link, but then it's also got, of course, the domestic situation. What's driving the narrative right now?
I know I always think Las Vegas Sands is the most ill-named of all the casinos because its exposure is obviously more overseas, and so that's what I think makes this so interesting, because we've gotten a lot of headwinds from China as a country over the course of this quarter. Yep. We'll have to see if this recovery is sort of faltering here. I think it's a good barometer for how things are faring in Macau and overall just overseas.
And then even here too, Vegas has had a lot of problems. Casinos are getting hacked. There's F1 that's like blocking all the roads. They had a massive weather event.
Right, and like Macau's, or not Macau, but MGM's website was down for like a week and a half. I mean, that was ridiculous to me. But when looking at some of their visitation and some of what we're expecting to see from these gaming volumes now in Macau, the year-over-year growth, I mean, I know it was basically shut down about a year ago, but it's still phenomenal. Zacks is forecasting actually their net revenues for the Venetian Macau to rise 555%, Londoner Macau 545%, the Parisian Macau over 1,000%, and Sands Macau up 830%. So again, I know it's compared to very depressed levels, but those growth metrics are still amazing to me. We are expecting earnings of around 53 cents a share. That would be up almost 300% on a year-over-year basis.
Aloha, Maui.
Revenue of around 2.7 billion, also up 170% on a year-over-year basis. So I mean, like, for a company that's as established as Las Vegas Sands, it's amazing to me to see this rebound. And I guess it would be more of the recovery, less the growth story. But still, if this company is able to basically report in line with estimates, that's a pretty strong comeback.
Yeah, seriously. I mean, the numbers here are going to be staggering.
Right.
So, but the stock, I mean, it still has been pulling back. And, I mean, I don't know, Rick. It doesn't look great, does it?
It does not. And things really started to go wrong once we slipped below 53.40. You can see here that was kind of a triple bottom type area here. We started to falter a bit there. We found some support at our purple 252-day exponential moving average. But once we dropped through with some conviction here. A lot of the trading was pretty heavy around this 58.50 area. That was our volume profile point of control. So we had a lot of bouncing around that point here. But since we did drop lower, we can see now we've got a couple clear nodes to keep on the lookout for near 46 and 49 or so. So those are some key price levels. You can see once again this area right here, 48.50 or so. Once we fell below that area, we saw an energetic drop off here. Now things are looking a little more range bound between maybe 44, 46.50 or so. Downward sloping trend line in effect though. Price is below all three of our moving averages. The moving averages are trending down. So the trend overall looks like you can pretty safely say it's down right now at this moment in time. Looking at momentum, we improved a little bit. We recovered out of the oversold area, but we're not doing anything else really notable. Not really any bullish divergence or anything like that. So the downtrend momentum is slightly lessening here, but it's still tilted toward the downside. So because the trend is down and momentum is bearish, let's look toward the downside first here. So we can see this 44 level, about where we hit our lows here if we start to break through that point. 41.42, if you look all the way over back near you, Oliver, that was a notable low that we established there. So those are a couple areas you could be watching. To the upside, 46.50 not only is about the top of that range, but it's also the 21-day exponential moving average. So that would be a key point to overcome to the upside.
And also that gap there that starts at 46.2, right? Because you had this range of trading, which was really the only place that LVS kind of paused on the way up from late fourth quarter last year into this year. So, I mean, the bulls kind of hope that maybe you close that gap a little bit. As far as bears go, I mean, they're going to start salivating if we break through the 44 you've got there. Because on the way up, we moved so quickly. There's not a lot of volume trading. I mean, it seems like it's
that's how it works.
Important moment where the expectations are that there's enormous growth on an annual basis. If like thousands or hundreds of percentage changes to the upside don't keep this stock from breaking down, then it seems like there is something really ugly happening in the shares.
Yeah, that would be a key level, 44 as well. And like you said, very little trading activity, but we're at fast-moving prices when there's gulfs in the volume profile here. Similar right here, we could be in for a big move upward, a fast move upward rather, if we start to cross beyond these nodes and get back up toward near the volume profile point of control. So the reverse could happen as well, too.
Sure. It's a good thing to remember how quickly the stock bounced and rallied coming out of the lows of last year, and maybe that gives us some perspective as to why perhaps the stock has been drifting a little lower despite all those big growth metrics that are expected. All right, last one you heard, Discover Financial. I don't think anybody's got any growth expectations really built into this at this point, Jenny. I guess they're kind of more like holding on for dear life, hoping student loans don't crush their credit payments.
And I guess hoping that consumers can still deplete their savings and spend on credit cards, because that would benefit this company, obviously, which is something we have heard, that we're seeing these increased credit amounts from consumers,
on the road
which is
again.
Concerning, but nonetheless,
Prosperity to
we are
you too, man.
third quarter that earnings that will decrease on a 10% on a year-over-year basis. Revenue, though, surprisingly, is expected to come in about 13% higher from last year. It's amazing, though, because when you look at this company's earnings history, it doesn't exactly have a really strong track record. They beat earnings in one of the last trailing 4 quarters. They missed in the other 3. The average earnings surprise is negative 2%, so they have more of a history of missing, I think is a fair assumption.
Yeah.
But they are expecting to have been impacted positively by some of these increased net interest income, which does serve as a really main contributor to their revenue. So that is a benefit that's expected to aid their top line in this quarter. So actually a little bit more optimistic than I would have even thought, just looking at actually, frankly, the chart and some of this company's performance over the last several years. Amazingly enough, though, the street analysts covering this name, 10 buys, 11 holds, no underperforms, no sells. So it's like the analysts must be seeing some of this resumption of student loans being a bigger benefit, or maybe not a major headwind for this company, because also the average price target does imply around 20% upside from where we're currently trading.
Wow.
So the street still likes this name. It's amazing to me.
Well, I guess we're kind of down near the lows, so maybe those price targets are kind of naturally look optimistic at this point.
Couple for the homies there.
No underperforms, even though we hear so much about this company in the conversation about indebtedness and eventually that cliff that the consumer will fall over. But I guess they haven't yet. But then Discover also had its own issues too, in terms of the last year of kind of some skeletons in the closet. I mean, we've had some massive gaps on this, partly earnings, but also some of the stock specific stuff too. So Rick, where are we at here? Coming off 52-week lows?
Yeah, we are recovering a bit from that point here. And the chart wasn't looking too bad before we got this big 1-2 kind of knockout punch here. Minus 16% one-day drop on earnings, then another big drop very shortly after, minus 9% when the CEO stepped down. So now we've got this situation where we made significant new yearly lows. We were in a downward channel for the most part here, but we've broken to the upside here. We've broken above our yellow 21-day EMA. We retested it, and a couple times we recovered. We're a good bit beyond that point now. The 21-day EMA is also starting to turn upward here. So the trend is improving a little bit. We've got a very short-term uptrend line to focus on now here. If we were to keep going upward here, momentum is favoring us right now. We saw a little bit of bullish divergence as price was trending downward. Momentum was trending upward here. Now we've broken above our 50 midline. We're making new successive highs with price here. So the situation could be starting to turn around a little bit here. However, we've got some notable hurdles to clear still. We've got our 63-day EMA, which is trending down. So the medium-term line that we follow is trending down. Our purple 252-day line is also trending down here. So it's kind of a situation here where you have to make the choice. Is this the sign that the trend is starting to turn around? Do I want to get in long at this point here and kind of bank on these early trend change signs here? Or do I go with the prevailing longer term trend and short this once we get back up to these old highs near 95.30? That's a tough question right now.
either way, it's a pretty fun trade.
Yeah.
I mean, anything that's got huge gappiness like this is going to be appealing to those that like to trade short term and look for extreme moves. Anyone who likes volatility likes Discover DFS. So I have no idea what to expect after the CEO ouster, some of the accounting questions, and I have no idea at this point how to think about Discover because it seems like those stock-specific executive things maybe have overwhelmed some of the macro, given how big of a sell-off that was with the CEO. So, all right,
and my energy.
Look at the chart, and thanks, Jenny. Nice look at the numbers and an excellent setup for some this afternoon. When we come back, we're going to get an update on Spirit AeroSystems, which is having a great day. Its shares are up 25%. Finally, some good news in the aerospace supply chain.
I don't think it's going to last. I don't think country can sustain. Look at the percentage increase on here. It's pretty astonishing. What? That real? That's crazy. Percentage-wise, this is actually insane. No way. 42% increase. This is after energy already went up like 28%. Make some phone calls. This is why you don't read your mail when you're trading.
Process. Should also note that Spirit AeroSystems also announced preliminary Q3 revenue expectations, forecasting $1.43 to $1.45 billion in revenue, an increase from $1.28 billion in the same period last year. But actually, that's below what Wall Street was expecting. They were expecting around $1.52 billion. So it doesn't seem to be weighing on shares today. More focused on this announcement with Boeing, but Spirit AeroSystems will report results on November 1st.
Bouncing
so we'll
yesterday's low, maybe.
Information.
Yeah,
then
potentially.
You should also note Boeing shares also getting a pop today, up about 2.2%.
I build an inverse
actually
cup here, maybe.
Closer to the unchanged line for the year, still below it, still down about 0.5%. but inching closer to that unchanged line.
All right. So production now going to hopefully, I guess, move in the right direction.
The line
Speed
there
up a
for
little
you,
bit,
40,
help those
432.45.
airlines get to where they need to eventually. We're talking
Middle
about
line.
this morning with Kevin as they're adding on capacity. The market hasn't been too crazy about that so far for the airlines, but the market certainly will be crazy about it for the suppliers. And now we finally see that as Boeing and Spirit firming up. Boeing had such a good start to the year and then dropped off so fast around last earnings. This maybe changes the tone a little bit going into the next report. So thanks, Caroline, for the update. An important one here is that's a very important company, frankly, to the whole sector. George Tillis and Scott Durfee joining me here this morning for a little convo in our market meetup panel before we close shop on MTL.
There is yesterday's
George
low.
and Scott both joining us from Salt Lake. All right. So, George, what's the big mover this week? Because we still have Jerome
Actually,
Powell.
almost
We got
reloaded puts
Tesla
there,
this
honestly.
afternoon. I feel like the economic data is
Still
not going to be
liquidity grab
huge,
from the
but
Bears.
after the way we moved on retail sales, who's to say we couldn't do something like that on jobless claims? So the bond market seems pretty sensitive. What's going to be the big story this week?
It is. I mean, well, I think kind
of wanted it to retrace a little higher,
if you
though.
Look at that, we're
didn't.
inching closer to new highs for the year, so I think that's putting pressure on the overall markets. And if you look at the S&P, OJ, I mean, right now it seems to be in a trading range in the past 7 to 8 trading days.
Close
and if
one
you
more
look at
down
it
here.
also from a technical standpoint, it's pinned between the 50 and the 200-day moving average. So I think at the end of the day, we're still in a volatile situation. I think we'll be higher by the end of the year, but I think there's a possibility we retest those 4,200 areas on the S&P 500, at least in the short term. I think at the end of the day, going forward, Fed speak, I don't think they're going to move on rates anymore. I think they're done. I think they're going to be stationary for quite some time and play it out probably into Q1 or Q2 of next year. We'll see how things play out. But at the end of the day, I think there may be a little bit of a relief rally based upon that again, may manifest in the overall markets, because if you look at all the monetarists that are really sensitive to where policy is going from an interest rate standpoint, that might create a short-term relief rally, and I think it may play out. But overall, intraday volatility is quite high still. I follow the markets very closely on an intraday basis, and this is a situation where with this trading range, it could break higher or lower, obviously, and the market wants to go higher, but I wouldn't be leveraged here because there's also a feeling that, we could see a spike to the downside for whatever reason.
Okay. Yeah, it seems like the sensitivity is very much there. Yesterday's big rally in the Russell just immediately reversing. That's never encouraging, Scott, when you can't hold a bounce for a day.
Yeah, but, it's not the first time that we've seen this also with the Russell, right? We talk about this frequently. When there's uncertainty in the market and when there's uncertainty in the world, there sometimes can be uncertainty in the markets. And I think that we're seeing a lot of that as well. We're seeing, when we see oil prices doing what they're doing, when we see, the threat of embargo coming, from the Middle East and all of these kinds of things, when we start seeing uneasiness or uncertainty in the markets, we start to see that flight to safety. And so we see yields go up. We see the dollar also increase. We're seeing oil that's prices potentially increasing. And so, we've got some headwinds here it's not all that unusual that we see these kinds of headwinds, but they're there nonetheless. And when they're there, that uncertainty can also create some problems within the market. Now, we do have some, a lot of great companies that are reporting earnings this week, a couple of them today with Netflix, Tesla, and others, and so much also will be dependent on what we're seeing here with, our domestic type of financial activity and so forth. So, there's a lot yet to be seen. There's a lot of unknowns still that we're discovering. We are range bound on the S&P, but we're seeing volatility within that range. And so, that's something that traders and investors will certainly be watching.
Yeah, it seems like really the news flow picks up today with Tesla coming out after market. And also bonds are selling off pretty heartily now. And we've got a 20-year auction coming up in about, 1 hour in Chicago time. George,
maybe we'll get a big move in the auction again.
Those bond auctions, should we be watching those carefully?
I think so. I mean, it's been inching higher. If you look at the 10-year rates, I think we're going to break over the 5 level. And again, I know it creates a lot of concerns for long-term bond investors, but I think we're near the peak when it comes down to rates, maybe 5.25% on the longs. But at the end of the day, I think the long interest rates give us some promising conditions. The economy continues to expand, and that's what I look at the long yields as. It's really a function of inflation and GDP growth, and that's a good sign. But at the end of the day, we also have to consider there's going to be winners and losers, and unfortunately, higher interest rates is creating a lot of problems for financial institutions which are paying up on deposits, and of course, looking at fixed assets like housing is creating a lot of problems. But nonetheless, you have to look at the positives for higher rates, which again demonstrates strong growth.
All right. And a little net interest income for some of the banks and card services too. But it is a tricky balance. Thank you, gentlemen. Scott Durfee, George Tillis, that bond auction at 12 p.m., by the way, Chicago time, 1 p.m. Eastern. I'll see you at 2 p.m. Chicago time, 3 p.m. Eastern for earnings. Mark.
Maybe starting to see some tapering here. Hard to tell, it's been so choppy this morning. It's not really, it's just a different. Might start getting calls on a break. It's very early though, 11 o'clock. Did the thing. One day. Yeah, one day. One day is better. Especially when you're trying to kind of time a bottom and waiting for kind of a more major reversal. Could take all day if it ever even comes today. I think like setting a timer for like maybe 11 or 12 or at some point switching from 0 days to one day is probably wise. Yeah, grab some calls also. Little starter. Very early. As we could be building inverse cup, could just be building a handle. So these calls I need to be prepared to exit for on a handle, which won't be that big of a return. I'll have a couple puts for the homies.
From last year, driven by fewer completed M&A transactions. The company's CEO did say that while the market environment does remain mixed this quarter, they still saw overall strong results, but they are navigating markets considering the fact that they're seeing a different landscape than what they saw basically a year ago. Their CEO did also say that these M&A announcements could translate into then more revenue growth than expected in the first and second quarters of 2024. It just depends on how M&As shape up, frankly. So interesting move to the downside here in Morgan Stanley, again, showing that we see a divergence in the performance of so many of these major bank players.
Thank you for that. So many of these names to watch, as you noted, under pressure today. And then we turn our attention over to United Airlines coming out with its quarterly report. Your thoughts on that and what people are talking about? It's moving to the downside.
Another mover to the downside again, showing that it's a little bit different of an environment than when Delta reported even just about a week ago. They lowered their fourth quarter guidance here and said this is a huge result of some of the geopolitical concerns that are happening overseas. And also fuel costs are expecting to weigh on now what they can expect for the back half of this year. They did report third quarter earnings that were better than the street expected. But I think, again, focus was all things guidance. They did say that right now they're suspending several of these flights to Tel Aviv through October, and they do expect that around $1.50 a share of Tel Aviv flights are suspended through the year. So they do expect an actual fiscal impact from what is happening overseas. We are expecting that they could see
climbing up there a bit.
Also remain
did get a bounce on
pricier
yesterday's
for the back half
low.
of this year, seeing a gallon going for around $3.28.
This
This
could
compares
be
to the third quarter average
tapering
we
at the
saw
bottom.
a year ago that was only $2.95.
Didn't retest this bottom of this
So as a
channel.
result, we are expecting to
Probably
see
get some more
then
calls
their
if we
operating
retest
revenues
this
sort of
other
fall off
shoulder.
here in the back half of this
We're in
year.
that range.
The airline
Add
did
into
launch
'em.
this in 2021, this United Next
Still very
plan,
early
which
though,
promised
only
more
11.
savings and more fuel-efficient jets. So the thought is that with some of these newer jets and
Very
more premium
patient,
seating,
especially when
that
today
could
was
then help
potentially
offset
going to be
some of
very
these
choppy,
overall
which
headwinds. But the macro story
kind of
I think is
was,
what's
but
very important to these airlines, and we get
just made a
American
big,
Airlines reporting
big chop
actually
range
Thursday
now. Big
before
fake
the
out to
market
the upside,
opens.
bull trap.
Okay.
This maybe is a
Thank
bear
you for
trap.
that.
We'll
Jenny
see.
Horn, market correspondent. Appreciate it. Good to see you.
Nice,
Now
Mr.
for
Press. Well
some
done, man.
insights on the news shaping the markets. For that, we
That's the way to
welcome in
best
Jason
way to play those
Botfield,
0
Smith's
days.
Partner and managing director at Stewart
Although
Partners. Thank you, Jason,
I like
for
to leave
being
at least
with us.
1 or
Your thoughts?
a percentage
We brought in some economic data. We got housing
open.
starts today. Retail sales was
Case
relatively strong.
SPY
People
climbs
think
on
that will sort
a
of
percent
help to
today.
boost GDP overall. How are you feeling about the economy, and what does that mean to the Fed, in your opinion?
Yeah, no, thanks for having me, Nicole. All this data that's coming in, it's been rushing in through the year, and the Fed's trying to make, edgewise of what's going on. And, I've really been going through most of the year in this kind of an analogy with clients saying that, there's a Fed inflation fog that's out there. And the consumer is, much like driving through a fog, you usually slow down, but the consumer has just been hard charging. They've maintained their speed and just driving through this economy and just spending. And so, this data is coming out there, but we're still in
stop on these
phase
calls.
of, good news is bad, and, bad news needs to be good news. So I think that we that the consumer being strong and potentially GDP raising, we'll have to see.
Puts for the homies got closed. Small profit on those.
On inflation, and I think we have to remain with that picture.
Right, understood. So at this point now, with still an inflationary environment, would one hike roil the markets? 1, 2 hikes? I don't know. What do you think might come along?
Yeah, I think, even just having it on the table has been the issue for the markets, I think. And,
we just got stuffed out of those calls too. Yeah, I did.
Going to be,
which is fine.
I think is probably off the table unless we just continue to see, unemployment not rising. Unfortunately, that needs to happen. We saw a little tick up on it, but we see inflation, core CPI, which is.
I mean, you don't have to leave a lot. I just leave like one, so you don't.
So
it's also just to prevent like FOMO and
versus a tick. I think you could see it this year.
Wanting to get back in if it starts going.
They're going to wait a little bit.
I want to be chasing, so just leaving one on the table.
First quarter of next year.
I mean, depending on your sizing.
But I think the market.
If you're only trading with two, then yeah, one's kind of hard. But still, you could leave half out there.
I think just having it on the table that they'll do it has been the issue because they wanted it, rates to come down at the end of this year, and that's obviously not going to be happening. So I think that it won't be a huge issue, but in the first part of the year, I think if they do it, or if they don't do it and it still remains on that they could, I think you could see some softness in the economy, in the market, and you could see really the U.S. market prices come down.
Yeah, understood. I mean, when we think about the end of the year and going into the new year, we often talk about that rally, sometimes referred to as the Santa Claus rally.
You're getting a little inverse head and shoulders, maybe.
Higher than where we are currently today.
You see a break of this.
I do think we could.
This
I think
break down below this resistance.
Kind of setting themselves up, like I said, that
back in for puts.
If the Fed doesn't raise rates, if it's just on the table, I think we could see that Santa Claus
we are
rally
kind of. I think we are tapering, so.
Risk
to the reward on puts probably isn't the greatest.
We have seen unemployment rates tick up a little bit. So we're going in the right direction.
Maybe if we get double bottom, we'll grab some calls again.
Moving fast enough, as fast as we see the consumer still purchasing. And I think that's what the Fed's trying to put the brakes on here. And unfortunately, because
AMC's down 2.8,
it's a little bit harder for them to, finesse it. And they
GME's
really
down 1.6,
in my opinion, around 5 or 6%. And so when we're sitting at 3.8% on unemployment, you've got this kind of doom loop on wage inflation and spending, and that if people keep spending, companies don't have to lower prices, and if employees are asking for more money, then you have this wage inflation spike. So inflation's making them want to have higher wages.
Let Bubba get the puts for us.
And it just kind of perpetuates itself. And the only way to get outside of that is, unfortunately, maybe a mild recession or that unemployment ticking up faster than where we're seeing consumer.
Yeah, I like it. I like it on the channel break. That could be a
recession. Expand on that a little bit. When
that could be the handle.
How long,
the inverse head
as opposed to
or inverse cupping handle.
Recession, which obviously sounds better. The mild recession. Tell me a little bit about that.
I think we've all kind of come into the point of thinking about recessions differently over the last even call it the COVID recession or whatever you want to call the dip there. But it just seems like with the new market data, maybe algorithmic, computers running things, is that when I say mild, I'm kind of thinking short and sharp, and it could be deep, but it's going to be short and sharp, and then we come back from there. And I really, that's really what I want to see. I think we've all been wanting to see
feel the
something like
in
that.
Me.
We get a 5 or 10% here and there, but we really haven't seen since a few years ago the real deep pullback, and that's really what I think of as mild. It's not necessarily it's only 10 or 15%. It's short-lived.
I'm gonna close one of these puts below a day.
Clients right now that I talk to on a daily basis, they think we've been in a recession for 2 years. So when I say a mild recession, talking to the community of advisors and professionals that may be running money, is I think it is just being short, sharp, and then we bounce back up from there like we've done in others. But it just has to happen to flush things out, I think, a little bit.
Right. And your strategy at this point, ultra short fixed income, tell me a little bit. You've been switching, right? Shifting from that to what?
Yeah, we made a pretty decent call. I think everybody was on the front end of it before rates hiked, that we needed to kind of get away from our intermediate maturities. But right now it's going to be tough to thread the needle. So we've been shifting out of our short-term, ultra short, positions and kind of going more into that intermediate side. We haven't fully gone there. I mean, I would have expected by this time at the beginning of the year, I would already be there thinking that maybe the Fed was going to have to cut or think about cutting in the early part of 24. But now I think it's probably summer
there.
or spring 24 before they'd even think about it. And maybe might have to be later. So we're going to shift, and probably by the end of the year have more or all of our position in the intermediate side, even though knowing that if they do raise in the first part of 24, we're going to get beat up on that, strategy. But there's just no way to time the market. So if you're trying to time the market, it's too difficult. Nobody can do it, even if they say they can. So, we're just going to think ahead and start to position, more intermediate from our ultra short term.
Not easy.
Bond positions, fixed income.
Jason Bottenfield, thank you.
If we're going to double bottom.
Appreciate it. Thanks, Jason. Plenty more to come here on Trading 360. We have the big three coming up. All right, we got ready for this one. Ben Lichtenstein is standing by.
All right, I got out of everything. I'm not gonna let the midday chop get me. Wait for it. Take a little double bottom there. Bit.
Go ahead and show you some of the areas of consolidation the market's formed. Help us determine our, working assumption whether it's right or not. At this point, we're looking for a breakout to the downside to further this trend lower, looking for a new area of value to form at a lower level. I want to add a little time onto this chart, though, sticking with the hourly candles. We take a step back, you're going to see that, it's not just
start scaling to stuff, it'll probably be calls.
Chart, you can see, goes all the way back to, we're talking when we were up around $90, and the similar fashion areas of consolidation that we formed at lower and lower levels kind of used a bit more of a fat crayon approach towards looking at this. But Don mentioned the $75 level. Here's what I've got my eye on, Nicole. Let me show you. First and foremost, we had double bottomed, if you remember, back in June, July, August, September of last year. And then we saw this big rally up, right? We were actually seeing areas of value form at higher and higher levels. So we were in a trend environment to the upside. But look what's happening here. Remember that $75 level Don just mentioned? Look what's happening. We're starting to take that out. That's a key area, which if we do take it out, it reverses the trend. Not only the working assumption that we're trending higher and reverses that trend ultimately, but as Don mentioned, open up the door for possible further weakness.
So the possible further weakness, and you just need that to happen in the next couple of months, basically, Don. Any final thoughts there before we get to Zoom video?
Yeah, aside the fact that home builders could be struggling right now, it's going to be recessionary discussions that I think can actually pull this sector back and pull it back quite substantially. And that's something that you want to consider in these trades, is less sometimes about the technicals and less sometimes about the fundamentals, and more about like, hey, look at the broader marketplace right now, which happens to be trending down. Again, the conversation of recession continually is right on the dance floor, and that could actually pull back this ETF as well.
Okay, you have a bullish out of the money call spread here for Zoom video. Why did that one jump out at you today?
So here's another one. We could talk probably a bit about the growth of Zoom or lack thereof. We can talk about, work from home, which is still quite considerable. Zoom's growth,
you're just stuck in that range. Once it breaks, then you have a good trade. It's building a ton of liquidity for
in terms of technicals,
2-3 months.
Channel, and that channel exists from about $60 up to about
breaking the upside, great. Bringing the downside, great.
Near the lower end of that channel right now, and I figured,
have a nice
why not take an upside shot inside a Zoom video? You know it, you love it, everybody uses it, but this is a stock that's really been beaten up in the last couple of years. This is also a January 19th expiration. I'm going to be buying the 70 calls, selling the 75 calls. So it's kind of the opposite of the previous spread. So again, buying the 70 calls, selling the 75 calls for about $1.30 debit. Just need a nice pop back to the upper edge of this most recent channel that we've been in for a pretty considerable period of time.
Right. Okay. Yeah, I used it at least once in the last month. Ben?
Well, that's probably why we've been trading lower, right? We have seen some weakness
here.
Right,
but did you pay for anything when you used it?
Definitely near the lower extreme of the channel, but until we get up above 69, in my opinion, a little bit premature to get bullish. This one, I'm going to show you why. Taking a look here, first and foremost, in this instance, we've got 30-minute candle charts, and we're looking at the move lower from 74.75 down to 62. And again, you can see the areas of consolidation. It's a similar situation, beginning of September.
Dang, I'm trying to go slow.
The recent lows that we just traded, and we're balancing around 66. The reason I say 69 is because while we're currently forming an area balance, we're referencing the prior one. That's our sort of line in the sand. If we're thinking that we're going to form areas of value at lower and lower levels, we don't want to take out the one prior to the one that we're currently forming. So again, these areas that establish themselves are actually really significant. They kind of leave us a little bit of a area to reference our trade and base trade on. Taking a look at the longer term chart, this is why I say it's a bit premature to get bullish. This one, you can see a very similar pattern in terms of what we were just looking at with that staircase, these areas of value which form at lower and lower levels. So in this instance, as long as we hold below 75, again in this daily candle chart, which we've been in a balance area that's been elongated, extremely mature basically all year for the most part, since February it looks like. Yeah, as long as we're below 75, still in a very bearish pattern here. And I just wanted to add a little time on this chart because what we're looking at here is the move lower from 290. We're talking November of 2021. Look at this chart here. This goes all the way back to, we're talking September, October of 2020. Similar pattern though, right? You see it playing out here again over multiple time frames, and even the further out we go, it becomes even more prevalent. Downside momentum, areas of value that continue to form at lower and lower levels with limited rejection as of yet. 75 is a line in the sand right now if you're looking at this time frame, Nicole.
Okay, thank you for that. Look, he's not so hot on your bullish thoughts. Quick thought on that, Don?
Well, that's what we love about other traders. You know, you got to take the other side of traders, and that's what makes the marketplace. But again, here, I don't think we're asking for a miracle. We're just asking for a bounce to the upper edge of that channel. And given all the way out to the January expiration, which is 90 some odd days out, it's plenty of time for this to play out.
Yep. Okay. And next up, Nike. This one you're a little more bearish on today. Tell us why.
So this most recent pop to the upside, I'm going to fade it, which for those of you that do not speak trader geek, fade it means take the other side. So Nike came off that 90 level, just a rocket to the upside, and it's been exceeding all expectations. That chart is parabolic right now to the upside. And these are kind of setups where I'm not looking for a wild and woolly kind of pullback. I just need somewhat of a pullback in the stock in the next couple of weeks. And this one is a little bit more shallow in terms of time. And that means, yeah, I'm looking for the pullback kind of in the here and now, not necessarily like months out. So in Nike, I'm only going out to the December 1st. So again, I'm still leaving myself a couple of weeks in here, but looking for that pullback. December 1st, I am buying the 103 puts, selling the 100 puts. So it's a $3 wide spread. It's done for about $1.20 debit. Again, fading the most recent pop to the upside off of that nice gap to the upside off the 90 level.
Okay. So at this point now, what are your thoughts on this one here, Ben, when you look at the technicals on this chart?
Well, I'm glad Don's not getting sucked into the most recent momentum to the upside because the longer term charts still show that shares of NKE are under pressure, but definitely did see a big move up in reaction to earnings. If you remember recently, the spike that we saw, it's on the left side of your screen here. We're talking about from 87 all the way up into this $90, $100 level, right? Significant move up, big green candles, high conviction trade to the upside. And then what I noticed in line with the product name, the company name, right? You get this swoosh and a big move. Don called it parabolic. No matter how you slice it, it was a significant continuation of that initial original move to the upside. I went ahead and identified some of the areas of consolidation that formed along the way up that I was able to look at, so we can determine again this footprint, this path that the market's taking. It also helps us determine an area where that may not longer, where we're going to see weakness or a breakdown of this. Currently bouncing around 103. Again, fine-tooth comb on this one, but you can see the big level right now, 102, 100. Anything below that right now really brings this short-term trend to the upside into question. And I did mention that we're seeing a bit of a longer-term trend to the downside. Here it is. Taking a look here at the 4-hour candle chart. In this instance, you can see three very well-defined areas. 125 after the spike up to 132. You've got 111, and notice how it's like every, $13, $12, $13 to the downside here. The market kind of pauses for a moment and sort of regains composure, and then again revisits and looks for that new area of value at a lower level. I want to show you what's going on here in terms of the weekly, because we're right at a pivot area right now. This balance that we're in goes all the way back to, we're talking about the beginning of 2022, spring of last year, and you can see we've basically been around this 105 level, struggling to get back up above it. Right now, continued weakness here opens up for a door for a retest of these lows that we saw last fall.
I climbed a little bit here.
But even on the longer term chart from 180 down. Well-defined areas of consolidation, migration of value to the downside. Trend is lower and no rejection of that as of yet.
Right. Okay. You know, we have a little time left. Just a final thought here, Don.
Yeah, you know, overall, markets have been rather resilient in the
VWAP.
face of some really tough geopolitical risk. But one aspect that you really want to be focused on right now, volatility, specifically volatility futures. We're very close to moving from what we term contango into what we term backwardation, which is a sign of, you know, all out kind of wild volatility. Just the point that how close we are for markets actually breaking in terms of volatility is actually quite disconcerting in the right here and now.
Okay. Thank you both for the big three today. Don Kaufman and Ben Lichtenstein, a great
Lichtenstein.
big three. We had some good ones. And you had
just trying
housing,
to
you had
close
Zoom,
one at VWAP.
and Nike today. Thank you both.
I wait.
Coming up next, we're going to spotlight big tech heading into
Close one. Right, wait for VWAP. Close one there, and far enough away. Far enough away. Minutes to EU close. AMC down 3.5 now. Give me up a quarter. GNS is down 4. Mullen been doing. Getting wrecked. Down 5%. Time for another reverse split.
Overall demand trends given this kind of murky macroeconomic environment?
Yeah, absolutely. Really looking forward to these reports. Okay, thank you so much, Caroline Woods. Great to see you. All right, time for a spotlight on some of those big tech names that we follow, right? Alphabet, Google, Microsoft, Meta, Apple. So they all report over the next week or so. Next couple of weeks. Angelo Zeno, Senior Equity Analyst at CFRA Research, is with us. Thank you so much for being with us. At this point now, what are your thoughts on what we are seeing or expecting for some of these names?
Yeah, I mean, listen, I think as far as kind of, some of the bigger mega cap names out there and expectations, I think for the September quarter, at the very least, I think the numbers are fairly are very attainable in nature. So we do think across the board, whether it be Microsoft or Alphabet, which are probably going to be the most important and critical to watch, we think, and it will be kind of the first of kind of some of those mega cap names within the IT and comm services sectors. We think those are kind of probably our highest conviction calls among kind of the mega cap type names out there. And then, as you kind of progress, I think Meta has a little tougher kind of road ahead of itself because the expectations have built up a little bit more. And then Apple, I think, just continues to be an extremely stable name to own out there. So maybe a little bit of a mixed bag out there with Microsoft and Alphabet being our highest conviction call. But all eyes, of course, are going to be on what the December quarter guidance is going to look like. And we do think at the moment right now, those numbers appear for the large part attainable in nature as well.
Yeah, that was a great summary because you gave us a little something on each one. So the highest conviction is on Alphabet Google, which obviously has been a great performer. Year to date, it's up almost 60%. It's just off its recent 52-week highs. What's going right for this name, and where do you think it's headed?
So in terms of Alphabet first?
Yeah, because that's you said you have the highest conviction on Alphabet.
As far as going into Q3 earnings season, I would say yes, Alphabet. So in terms of what's going right here with Alphabet, I mean, it's really kind of them going on all cylinders here. So you kind of look at their biggest segment, and of course it is search. We're looking for growth to accelerate to about 6 to 8% growth here. in the September quarter. We're looking for a very comparable type growth rate in the December quarter as well. It would be an acceleration from about 5% in Q2 and a low single-digit growth rate in Q1. Now, we're seeing that momentum because the digital ad spend is recovering. You're seeing easier comparisons from a year ago. And I think overall, some of the AI initiatives out there will also continue to help kind of help across their entire business lines. I think as far as some of their other segments, we're looking for cloud growth of about 28 to 30% out there, remaining elevated from what we've seen over the last couple of quarters. Again, AI initiatives, what they're doing with regards to workspace out there is going to be very important to monitor in terms of that business. And all the AI initiatives going on there. And then, of course, with YouTube, I mean, we know the Sunday NFL ticket package was added this year to Alphabet. We know kind of the NFL season started in September, so we do think that there were increased subscriptions kind of going into that into the start of the NFL season. So we do think YouTube growth accelerated in Q3, and again, looking for a very good number in Q4. So as far as those three business lines are concerned, we think overall they're going to hit and exceed expectations across the board.
Yeah, and I don't mean to quiz you, but Google right now at 140, the recent high is 141. Where do you think it's headed?
Our 12-month target price is $157, so we do think there's notable upside there. I think it's also important to note kind of the cash return strategy out there to shareholders. They've got a $75 billion buyback in place. When you kind of look at the balance sheets across kind of the biggest names out there, it is by far the most attractive, even more so than that of Apple in terms of their net cash position. So also important to kind of note there.
All right. Next up, Microsoft, which is at 333 today. The recent high was 366. I'd like to. This is another name that you have high conviction on at this point. Yep. Where do you think this one's headed and why?
So we have a strong buy recommendation. 12-month target price is $407 there. And again, we see some good upside there. This is a name where probably disappointed the most when they reported their June quarter results, because I think the street had very high expectations in terms of the AI initiatives out there. Essentially, the company guided that it's going to be more modest in nature, but still positive nonetheless. I think, of course, all eyes again for this company, similar to Alphabet, is going to be on the cloud side of things. Azure is going to be very important. We're looking for growth of at least 26 to 27% on the top line. Greater AI contribution in the September quarter versus the June quarter, and we think they guide again to additional kind of AI contribution in the December quarter. So important to monitor there. Of course, in terms of the guidance for the December quarter, you are going to have Microsoft in terms of kind of rolling out Copilot in November in terms of 365. And it'll be interesting to kind of see what the guidance is for the December quarter on that side of things, what they're looking for as it pertains to that, because any type of positive indication, I think, again, will kind of maybe drive more excitement in terms of the Microsoft story there. Although we do think it's going to be more notable in the March and June quarters of next year, I think any type of incremental positive commentary on that side of things could be a catalyst for the stock.
Yeah. I don't know if you want to give me 10 seconds. Microsoft signing Amazon as a customer. This is reports, right? They haven't confirmed this. In over a $1 billion cloud tools deal. It would be a 5-year deal. The companies did not immediately respond to this. But is this a big deal to you?
I think it's a good deal. I mean, the fact that you've got these companies collaborating with each other, and any type of kind of sizable deals out there that kind of Microsoft comes out with, I think is always a positive. So I think it's an incremental positive. I don't know if I'd make a huge deal out of it just yet.
Right. Okay, but it seems.
Mr. Invest, you had a couple runners, but yeah, no, you could.
Not on my end.
My concern is just that more macro inverse cup and handle.
Drone delivery of medication for Amazon at the same time. I mean,
that's why I kind of got a little over trading here.
Tell me a little bit about Apple now, because obviously
confirmation that that's not happening, I would say, is probably break of VWAP.
Where do you think Apple's headed?
Yeah, I mean, listen, think
higher
about
levels.
what Apple is doing just this year alone, right?
And
I mean,
then we're looking at
when we
maybe
look
a
at
couple on
calendar
today.
23, we're looking essentially for flat revenue in calendar 23.
But if we start to reject up around here,
And you're looking essentially at earnings growth of about 6%
draw some
year over
lines
year
and
on flat
put it
revenue.
out there,
So
but
how are they doing
then
that?
we're
Right?
looking at
They're
maybe
doing
a
that through a
new
number of
low,
different things. One, you've got some
or at
significant
least a test of
buybacks
the
that they
low.
continue to do on a going forward basis. You've got that services growth, which has 1.5 to 2x the type of margins that you have on the hardware side of things. So that continues to go unabated, along with kind of the installed base growth. And then you continue to see margin expansion, from the favorable mix on the services, but also because of what they're doing in terms of some of the cost synergies on their hardware side of things. So this is a company that, despite the fact that they're not seeing some, significant growth, they continue to see some decent growth in terms of on the earnings trajectory side of things. At least we think so. As we kind of go here into the September, December quarters and looking ahead, I think, of course, a lot of interest in terms of China, in terms of the momentum on the iPhone 15, what that cycle is going to look like. Again, we're not looking for anything substantial in nature in terms of the iPhone 15 cycle. In fact, we're actually looking for Apple to essentially grow in line with the smartphone market over the next 12 to 15 months, as opposed to what they've done over the last 2 to 3 years, which has been take significant share gain. But that said, they did hike up the price in terms of the Pro Max. That will help in terms of the pricing strategy side of things. And we do think they now, lap some easy comparisons over the next 12 months across the hardware side of things. So all will help them in terms of, going ahead.
And Angelo, just the wild card, anything that you're super excited about or surprised or watching really closely as far as themes or a particular company?
Listen, I think it's all going to be AI this earnings season again. I mean, I know it was kind of the name of the game last earnings season. I think everyone's going to be looking at it. I think it's going to come down to Microsoft and Alphabet. They both report on the 24th. What they have to say in terms of the guidance, Microsoft in terms of Copilot and the AI initiatives on the cloud side of things, and what Alphabet has to say in terms of their search generative experience. They've got Gemini, which is kind of the next generation large language model, kind of launching here over the next couple of months as well. What both companies have to say on the AI side of things, I think it is going to be extremely critical to the market and those companies themselves.
All right, Angelo Zeno, great to see you. Thank you so much. Good luck at those some of those magnificent 7 names. Really appreciate it. All right, George Silas is with us, taking a look at the disruptor, and today's company is ServiceNow. So the stock has been a real winner, up about 60% over the last year. Why is this one jumping out at you today, George?
Well, I mean, if you look at ServiceNow, obviously the stock has performed quite well over the last year, up 60%.
Volatility
You're also
about?
seeing, prior to the earnings release next week on the 25th, there are analysts that are actually rather constructive on the stock, upgrading their price targets. For instance, Needham has moved their price target to 660, and if you look at JMP Securities, they also reiterated an outperform rating on the stock with a target of 665. I think if you look at ServiceNow, enterprise productivity is really the name of the game when it comes down to this particular business. Everything that has to do with technology workflows, employment and customer workflows, as well as creator workflows. This is another area of the software enterprise business that the ServiceNow has actually moved into. But if you consider the earnings that are coming out next week, in terms of the estimates, they may end up being quite low relative to what they perform at. Going into it, they're expected to earn about $2.54. So that's 29% compared to last year. But if you look at the sales estimates at $2.28 billion, that's about 30% compared to the same quarter last year. So I would look at this and perhaps say that the earnings estimates may be a little bit conservative.
Buy them as close to your stop as you can, right?
You have to consider switching costs. I mean, 85% of Fortune 500 companies use ServiceNow in some capacity, and the company is very profitable. They're earning about an 18%
Just got
margin.
VP of barbecue. Got it. Now you're learning.
Still growing close to 30% in sales.
Cup and handle. On the longer time frame, inverse.
And so how would you go about an example trade now?
There it is.
So we got earnings next week on Wednesday, so we got to keep that in mind. So there's quite a bit of volatility in the weekly options for next week, but we can still capitalize on a bullish trade and neutralize
the impact
of that volatility by structuring a long call diagonal. So what we're going to do in this case is we're going to be selling the October weeklies that expire next Friday. we're going to sell an out of the money call. That's the 590 call, which is above
yeah,
the
if you
current price, and we're going to use the proceeds
just here,
to help finance
inverse
in
cup.
the money November monthly expiration. This is in
Could
30
just
days.
could be making a handle.
560 calls. Sorry, the 540 calls. So altogether, this would cost a trader about $30 a share or $3,000 a contract. So it's quite expensive, but you have to consider that we're buying the 540 monthly calls, and it already has $20 of intrinsic value. And ideally speaking, we'd like to see the stock around the 590 by expiration, of course, next week. That would be the sweet spot. But what's nice about this position is that effectively the stock only has to move about 1.5% to break even, which in this case is 570.
Hopefully rad is a
expiration in
little different than barbecue.
Okay. George Sillis, thank
It's
you
not
for
uncommon
that.
for some stocks to go in and out of bankruptcy like multiple times.
Thank you, George.
I think I want puts
Coming
here.
up next time for our 360 round, we're focusing all about Procter & Gamble. The company did beat the street on estimates, maintained its guidance, and so the question is, are people underestimating a name like
theirs
Procter
is just kind of to
&
pay
Gamble?
for
Our guests will explain next when Trading 360
to carry them through the
returns.
lawsuits.
We'll be right back.
I remember when I first started flying.
I did get some puts. Smaller position. I don't like trading in the middle of the day. I don't like the chop. We'll see. I'm out. Take it easy. Take it easy.
they've sold off back in 2014, 2015, about 100 brands from their mix, keeping their core 65. And those span laundry, diapers, hair care. And a lot of that are products that consumers use every day in and out. That usage might change based on their economic and financial condition, but they continue to use those particular products. And so, and because of the investments in innovation, consumers don't want to just spend money on something that they fear may not work. And so the innovation across price tiers, I think, is particularly advantageous in terms of keeping consumers within their portfolio of brands. As it pertains to the stock price, we think shares look slightly overvalued at present. That's not to minimize the strength of the brand portfolio, but we think shares have run and are a reflection of the solid performance, both as it pertains to the top line and bottom line, that the firm has been generating quarter after quarter.
All right, so slightly overvalued. It's at 148 today. Greg, when you look at this and you think about the cost reduction initiatives, tell me a little bit about that. And this stock, I don't know how much you comment on stocks, but it is trading at 148 today.
Well, we've seen all of these large companies start to ramp up their cost management programs as a response to inflation. This quarter and the previous quarter was when you really started to see those impacts on margin, and then we'll expect to see it over the next 3 to 4 months. And what's really interesting is these companies aren't really transforming in the traditional sense. They're taking much more of a regenerative approach. How do they create change and growth from already strong businesses?
Yeah. When you look at the competitive landscape here, Erin, what are you thinking as far as that goes? Because you did say how they sold off back in and they got rid of probably 100 products, really focusing on more of a core, maybe 65 plus. Does that give them some sort of, not moat, but does it give them more strength because they're viewed as the power player in this?
It enabled them to really focus their resources, both financial and personnel, on those core brands within their mix without sacrificing scale in terms of their negotiating leverage with suppliers and with retailers. So that does underpin the way we think about the firm's competitive positioning. As it relates to the overall competitive landscape, though, over the last 3 years, promotional spending has by and large laid idle, given the supply-demand imbalances that we've seen. And so now as those issues have been rectified or are being rectified, and as commodity costs start to come down, we anticipate that the competitive environment will become more intense and that promotional spending could step up, which I think is a fear within the market and across the consumer products realm in terms of how leading companies like Procter & Gamble continue to respond.
When you look at the Staples Group,
I'm up on 12 o'clock.
Strong buys on
Buys down almost 0.8.
Keep an eye on other names.
Yeah, we think that Clorox looks attractive here, as does Kraft Heinz, across food as well as household and personal care.
Got back into calls.
Both have been plagued by, in the case of Clorox, by transitory issues in terms of the cyber attack.
Wasn't the break.
In terms of Kraft Heinz, they're
I
still
don't think so. Maybe it's becoming
building
that.
back and regaining some
just looks like it's
momentum
chopped.
after underinvesting in their portfolio back when the merger first transpired several years back. And we think that both are really focused on investing for the long term, and that should aid their prospects going forward.
All right, Greg Portell of Carney and Erin Lash of Morningstar. Thank you both for being with us. Really appreciate it. Good luck there.
Tell you all that overtrading, they'll get back. They make their profits.
Well. Thanks for being with me, friends. I'm Nicole Petalides, live here on the floor of the New York Stock Exchange every single weekday.
Didn't have big profits, but plenty good on the day. I could have just called it.
On Schwab Network. So I'll see you at 2 o'clock for the watch list. In the meantime, keep it right here. Fast Market is next.
Choppy markets next. AMC's down almost 5. That's why I opened up the WSOP earlier. I just never started playing it. Should have started. Distracting me from candles. And that inverse cup and handle's kind of in the back of my head, which conviction weak. I might have to keep waiting for next hand. Feel me in. Spy. See if we get a triple bottom, flush through.
Lows, the benchmark S&P 500 down about 0.8%. The Dow Jones Industrial Average off nearly 200 points, or 0.6%. The tech-heavy Nasdaq 100 off 0.7%, and the Russell 2000 leading to the downside, down 1.6%, reversing all those gains we saw yesterday in the small caps, and a little bit more today, and some weakness in those names. To help me break down this market action, let's bring in my co-host. That's Kevin Hinks. Kevin, I feel like the market's bifurcated it right now, where retail sales were strong this week. It seems like earnings season's humming along at a decent beat rate at this point on some lowered expectations. But then you throw in that thorn in the side of the market right now, and that's the bond market. You've got yields hitting 16.5-year highs right now on the 10-year.
Well, the problem is you've got a strong U.S. economy.
Yeah.
And the wage data that we talk about and the labor discussions that we talk about feed into wages. Wages feed into disposable income. Disposable income feeds into retail sales. I can keep going, but right. you get the idea. And so interest rates are sticky, and you don't have the Fed in there buying. You have the Fed actually in there reducing their balance sheet, so they're not helping.
Right.
But eventually, Tom, we're going to get to an edge here. And did you ever hear that phrase, push until it hurts?
Yeah.
Right? If you watch Suits, push until it hurts. Well, we're going to get there, but there's more, Tom. There's geopolitical risk.
Right.
This risk there, we're naive to think this is not a big deal because it is. We're naive to think that that's not going to escalate because it is. So there's that out there too. But here's a little bit of a sad thing. The U.S. economy's kind of chugging along here, pretty healthy clip. Earnings look good in most cases. The economic data is strong.
I wonder what this guy had.
Now, that's good and bad, obviously.
Right.
But all things considered, the U.S. economy, here's the good news for everyone out there. U.S. economy is doing pretty well.
Yeah, and that's kind of the point that I was trying to get across is, hey, you know what? Economic data is not as bad as expected.
No.
Job market's still robust. Wages are increasing. But, like you said.
Retail, GDP expectations are going to go higher, not lower.
Yeah.
Based on some of this data.
Yeah, and we get that first read next week on Q3.
Right.
So we'll keep that in focus. One of the names that's struggling today, Kevin, that's United Airlines. We've been talking about the airlines all year as they hit all 52-week highs in midsummer around July area, but they've all been trending lower. We had United Airlines report after the close yesterday. Let's bring in Caroline Wood, senior markets correspondent here. Caroline, we talk about the demand for flights, and it continues to move higher. TSA numbers are above 2019 levels, but it just doesn't seem like these airlines can figure it out. They've got razor-thin margins, and you got fuel prices rising. That's not helping, right?
Fuel prices, higher labor costs, and of course the Israel-Hamas war all weighing on United Airlines. Not necessarily the quarterly results that we just got, but their outlook.
Didn't have it in me to average on my calls on that potential triple bottom there.
Totally sinking today. Shares are down. They're already off the lows of the session, but still down about 8% right now, and we're seeing follow-through across all of the major airlines. So
United
down about 8%, Delta down 4%. American Airlines down a little bit more than that, even JetBlue and Southwest.
I like to make sure to add my calls in big green
today,
candles.
but drilling down into those UAL numbers, adjusted
Close them on
EPS
big red candles.
$3.65. Top analyst
This is not
expectations
the way.
of $3.40, so a beat on the bottom line. Also a beat on the top line. Revenue of $14.48 billion came in slightly higher.
There it is, triple
than
bottom
analyst expectations
engaged.
of $14.44 billion. However,
Wow.
United pointed to lower
With that
profits for the
candle.
fourth quarter based on all of those factors that I just mentioned, and that is certainly weighing on shares today. For Q4, United expects
Closing a couple of
EPS
PWAP.
of $1.80 if flights to Tel Aviv are
Hardly
suspended
even
through
up on these now.
October. If they're
All my
suspended through the rest of the year, they're
overtrading and
expecting
flip-flopping.
EPS of $1.50. Wall Street was expecting $2.09 per share. So even at the higher end of that range, that's well below what Wall Street was expecting. Meanwhile, also expecting higher jet fuel
Back to the
prices
chop.
in
Is
Q4.
that what you're gonna do there, Spy? That's it. That's the plan.
$3.28 a gallon versus $2.95 a gallon.
Still early. It's only 12.
Fourth quarter
Wow,
operating
look at that.
revenues are expected to be 10% higher year over year and 9%
Ugly.
higher if the Tel Aviv flights are still halted through the end of 2023. I will say Helene Becker over at TD Cowen, she's an airline analyst, said the fourth quarter guidance is bleak and worse than our estimates. And then for the full year, United would earn between $9.55 and $9.85 per share on an adjusted basis. That's down from its prior forecast in July of $11 to $12 per share. So that's based on the projections
Oh my
for the
gosh,
fourth
look at that
quarter.
candle.
So, definitely not good in terms of outlook. But yes, a beat on both the top and bottom line, and not
Holy
because
chop-a-moly.
demand is weak. You hear Scott Kirby, the CEO of
I should have sold
United,
more.
talking about demand being strong, no signs of weakness in the consumer, but they are facing higher costs across many levels, and then of course this new headwind with the war in Israel
Adding
not
some
helping
calls
at
there.
all.
Yeah, Caroline, we all thought that there would be some disruptions, some effect on fourth quarter earnings per share based on the war in Israel. I didn't realize it was that heavy, though. You're talking about more than 25% decrease in fourth quarter earnings if it goes to the end of the year. Throw on the fact that fourth quarter gasoline costs are going to go from $2.95 to $3.28. Boy, thank God this company, this airline has the demand that they're talking about, because some disruptions here could really weigh on this. I just had no idea that international flight to Tel Aviv and those markets caused so much of United's earnings. That's a big number.
Well, and it's really only like 2% of capacity, I believe. So
Yeah.
yes, it was surprising to me as well. But really, when you hear Scott Kirby talk in media interviews after these results, he really focused on the higher labor costs as well, saying they were higher than anyone.
Yeah, too many people saw a flop. I should have re-raised his raise, but it was an aggressive raise.
Things like delayed aircraft from manufacturers and air traffic controller shortages. So it's not just that one thing, but yeah, certainly, pointing to the war in Israel as reason for kind of scaling back those expectations. And obviously, there's just a lot of uncertainty about how long that will go. Hence the $1.50 to $1.80 in terms of the range. But yes, it's not without its fair share of headwinds. But luckily, as you point out, the strong consumer is not, at this point, one of those headwinds. Obviously, TBD, we keep waiting for this consumer to crack.
That's to be determined. Okay, guys, to be determined.
Student loans and whatnot, but certainly doesn't seem to be the case.
Make sure you're clear on that one.
Yeah, and United is the biggest major carrier over there in the Middle East. Yeah, in that area. So that's definitely a concern. And then crude oil back above $87 a barrel. That's not helping at all. All right, thanks to Caroline Woods, senior markets correspondent here, breaking down the United Airlines earnings. But now let's bring in Alex Coffey,
let's blow this
senior
pot up a
equities
little more than
contributor
that
here on the network. Alex, I kind of wanted to get your take here on the risk-off momentum that we're seeing today. The only two sectors up in the S&P 500 right now are energy, with crude oil prices rising, and consumer staples on the back of maybe Procter & Gamble's earnings. But you've got gold at 1-month highs. You've got the dollar higher. You've got yields higher. I mean, this is complete risk off right now.
Except for the yield aspect, right? Like you'd expect treasuries to be being bought in that environment. You're not really seeing that. You aren't necessarily seeing a steepening of the yield curve or an uninversion taking place, at least on the longer end. They are starting to catch up with the shorter end, as the 2-year is not really moving to the same extent that you're seeing, let's say, the 30 or the 10-year. I mean, we have a 10-year that's just under 5%. We have a 30 that's right at 5%, with a 2-year that is, let's call it 5.18, 5.20 in that range. So, I mean, we're looking at this 2-10 spread getting quite close to uninversion. And if it does happen from the 10-year catching up to the 2-year in the way that it has been, this sort of bear steepening, that's kind of interesting, because it's quite uncommon. It is typically associated with the soft landing scenario. But, man, there are so many risks still out there. I know Caroline mentioned student loans. We talk about lag effects. I mean, there's going to be a lag effect to that. And so there's starting to be a sentiment that that's going to impact the October numbers a little bit more so than they have in September. Look, I don't know how it's all going to play out, but I think it's really, really difficult to say that the coast is clear right now. I think there's plenty of uncertainties, and really any combination of them being slightly worse than expected. There's not a lot of cushion, let's say, for things to land softly. A lot of things have to go right, is I guess what I'm trying to say. It's a needle being threaded in a very, very tight window.
Yeah, now, when you look at that, and this is probably to both of you guys, that 210 kind of coming together here a little bit.
Straight there.
It's been inverted for so long. Basically, in history, it's always signaled a potential recession. But if you look at
it, pocket aces, no way.
Right, and but
got trips on the river.
Is that telling us with the the jobs market still robust, wages still going up, consumer spending still out there? We're going into the fourth quarter. Everybody spends during the fourth quarter historically.
Everybody.
I mean, it seems like that soft scenario landing, but it doesn't seem like there's a rooftop right now for that 10-year yield.
Well, listen, we're in a unique situation for many reasons. We're in a unique situation. Fed buying of bonds in the past was unique. Now selling them is kind of unique. I think the steepening of the yield curve via this course is unique, and what it means for the overall economy. The U.S. economy is stronger than we think, and it's stronger than we thought it would be. and that retail sales, these surprises on the upside. Oliver, Rick, and I talked about that this morning. The surprise index is shooting higher. So we're getting so much data that is strong. But here's the thing, Tom. It's not really the inflation data that's real strong. Other than PPI, which is kind of a discounted metric, the other three numbers aren't spiking higher, aren't moving back higher. So it's a really, really unique economic environment we find ourselves in because the economy's getting strong.
New York.
But inflation
I like how low the
isn't
VWAP is.
reaccelerating yet. I don't rule that out for the future, though.
Yeah,
I guess it'd be pretty,
and Alex,
pretty good trade on a break of that.
2-year, 10-year yield spread down to inverted by 32 basis points. That's one of the the lowest levels or better levels that we've seen over the last 52 weeks or so. So when you take everything that kind of Kevin commented on, what that means for traders and investors, because you got the VIX rising, you've got the uncertainty, the geopolitical side of it, but now we're into earnings. Shouldn't that matter most?
Dude, these
I think it
candles
should
in here
matter
are
a
crazy.
lot. And I think that the key distinction, I guess, and kind of word choice
back
that I
to
would
nothing.
make is I don't
We have
consider
one
the
on.
economy necessarily
Williams
strong.
is speaking.
It's not as
12:30.
bad as expected. We've had 3 straight
Waller's
quarters.
at 12.
not
That was maybe from
4,
Waller.
in which earnings have declined on a
Time is that
year-over-year
at?
basis. I don't necessarily.
Yeah,
I
that
guess,
was Waller
put that in the
probably.
strong camp, but we haven't had
Given that
this
volatility.
all-out free fall recession-like activity that maybe the bond market seemingly has been pricing in for the better part of 2 years too. So it can be better than expected and not great at the same time, I think. Also, if we go back to March and April, there was tons of uncertainty around regional banks and sort of the financial stability of some of these different banks. And so much of that was tied to the tremendous sell-off in bonds. Well, we're seeing that resumption of the sell-off in bonds. If you look at something like the BKX, which is basically a banking sector index, what you're going to see is the banking sector is not doing so well. So I think that some of those concerns maybe won't hit that same level of fever pitch of risk and uncertainty as we saw in March. But some of those problems come back to the forefront the more that bonds go into free fall, and I think that complicates the situation going forward.
Yeah, that BKX down 24% so far this year. The banks have lagged the overall market as far as gains go. Kevin, when you look at some of the housing data that came out this morning, not too much to talk about with housing starts and permits, but mortgage applications, that 30-year mortgage rate hit 7.7%.
Yeah.
That's the highest level that we've seen
breaking
in over
that channel
20
again.
years. I mean,
Remember, I was commenting earlier in the week how maybe this might be a good number for mortgage apps because yields had backed off in the last week. Well, that didn't show up, now did it? It was not only not positive, it was horribly negative.
Yeah.
So yeah,
It's so choppy.
I
I
saw that
can't
number
really
this morning.
trust
I'm
these
like,
right here, right now.
Yeah.
Wow.
That's
I
the
mean,
unfortunate thing.
Listen, you can't make a real
Better to wait for the
case
full
to
confirmation
refinance
breaking out of this
in terms
chop.
of a mortgage. So 9.9% isn't surprising me. But existing or new homes that people are buying, that demand just needs rates to settle down here, and I think that'll be okay. But refis, no reason to refi.
no, not at all. Why would you move at this point? Alex, when you look at maybe some of the other earnings, Procter & Gamble's doing really well, but Morgan Stanley's fallen pretty substantially. JB Hunt, I always look at those transports for a good overview of the overall market. UAL in there also. Those are both down significantly. So there are cracks in here as far as earnings go.
Yeah, margin compression is going to continue to be the story, and I think that will continue to be the story. But does that affect NVIDIA? Does that affect Netflix? Does it, it will probably impact Tesla, as we'll get, this afternoon. But some of these different names are just in industries that, the growth is going to overshadow that, so we'll see. But what I will say for certain is if I had to sum up this particular earnings, what I believe will be the story, it's going to be margin compression if I had to choose 2 words.
Well, that's a good lead-in for our next segment because we're going to take a quick break. We're going to talk about Tesla, where they have shrinking margins over the last year because they have cut prices, but they're taking some market share too. So what's the trade-off there? We're going to talk about Tesla next when we're coming up. It's up over 100% so far this year.
Guys. I'm gonna close more at the next test up here. Closing such a small percentage each time. Dang, this is just so ugly. 9 to take your money day. Like every day, but one for a fourth test on this. A lot of false signals today through this chop. Morning chop. Afternoon chop. I might fully exit these at a good VWAP test. But that's probably when we'll have the continuation. Let's come on, guys. No folds. A7, dang. Why would I fold? I have a pair of threes. Why would I fold? Like king 8. Ugh. Quadruple bottom. Instead of there's new low flush. Instead of scaling down, I scaled up, which is also stupid. So I was thinking Yeah, recoup back some gains. Never a good mentality. Also, yeah, I should just stayed with my smaller sizing. Well, I averaged into it because I thought the move was more confirmed to the upside, but apparently not.
Model that allows for a little bit more price elasticity with not having to go through the dealerships the same way that other car makers do. So I guess long story short, Tom, I think really when it comes to Tesla, where I would start is, where do you feel that the aura or sentiment around Tesla is going into this report? I would say that the sentiment is negative right now. Lower prices, lower demand, less production, all of that seems to be what's swirling around it. So then from there, what do they have to say to deliver upside, and what do they have to say to deliver downside? Elon must have been pretty good with a microphone. I would suggest that they can probably talk their way out of any of these negative stories quite easily.
Yeah, I'm sure there'll be some fireworks during the press conference that comes after the release of the report. But automotive gross margins expected to fall to 19% from 28% a year ago.
Guys, in their
Option markets
pre-flop
pricing
bets
at
are
about a
insane.
$14.30 move in the shares either
Can't get
way.
enough.
Alex, we've seen some outsized 2-3 standard deviation moves post earnings in the history of this stock. How do you want to look at it from a trading perspective?
Yeah, and I would say
Just getting
too
dealt
that
cards,
as
too,
it's
huh?
matured as a company, those have become less common because we do get their delivery figures. We are able to sort of get an idea of what the financial picture is in a name like Tesla ahead of time. This quarter may be a little bit different just because there is that uncertainty with margin compression and sort of those cost controls will be very much in focus. But I looked at a neutral to bullish strategy, Tom. I think the sentiment's pretty beaten down in this name right now. I think that there's a chance that with this sell-off even into it today, that you could have a kind of sell the rumor, potentially even just not sell further the news. It doesn't necessarily have to be a buying of the news, if you will. But I looked at a skewed put butterfly, attempting to bring that break even down. At the time, this was close to where the market maker move was targeting. The stock's been under a little bit pressure since then, but went out to the end of this week. Bought one of the 242.5, sold two 240s, and then defined the risk, going $7.50 lower
All
to
in,
232.5.
everybody.
Looking to
Why don't
collect
you
about
guys
$1 on this. I'm guessing it's a little bit more than that now, but
Just
just
one
sort of
showdown with one
around
person.
$1. That would bring the break even to 236.50. But risk defined. So you got $400 in risk if this thing collapses.
AMC's down 6%.
And falls below 232.5. You have a chance where it can expand to as much as 350 if it just goes down slightly, and that would target
More
about
ace?
$6
Dude,
lower to 240.
this guy? Oh my gosh.
And this is where I think it's fun because it's where the plan could come together. It's down $8 right now. If you add another 6, you're right around that market maker move from the start of day price. If you're kind of following my logic where maybe we're selling into this with the anticipation for disappointment, maybe some of that is front loaded, gets to 240. That's right in the best case scenario for this trade.
Yep, let's break this one down. October 20th weekly series, so just 2 days till expiration on this earnings example we've got here. Unbalanced put butterfly to the downside, buying one of the 242.5 strike puts, selling two of the 240 puts, buying one of the 232.5 strike puts. Collecting roughly $1 credit. We've got $1 credit on the risk profile here, trading closer to $1.20 credit at this point. But your break even, 236.50 to the downside.
Okay,
so you
I'll
have
call.
some cushion.
Yeah,
You get
I
that
figured you had a
kicker,
higher
Kevin,
club. Of course you
right
do.
at or near that
You're like a
240 strike.
magician.
And as Alex mentioned, about $400 in risk per spread if it does collapse.
It's a put butterfly that's long deltas and does better on the upside, right? It's kind of, it doesn't feel congruous there, but because he has a
You have a king of clubs?
$2.50
Oh my
vertical
goodness, dude.
and a $7.50 vertical, he trades it for a credit. He's got his peak around the short strike around 240, but anything on the upside, he collects his credit and he keeps his money. The risk,
Dude,
obviously, on this trade
getting
is a
dealt in the
catastrophic
hands.
move to the downside, but the risk is about $400. If it's $1, if it's $1.25, it's $3.75. So not catastrophic.
Well, there's
move
more
in
signs
either
of tapering
direction,
here.
but something that flat, down small, or up,
Right.
and it's profitable.
Yeah, you got $10 cushion down to that break even also. So a good look at an unbalanced put butterfly for a credit.
This
So anything
holds.
even above that 242.5 strike you get to keep the credit that you collected on that. But a look at an earnings play type strategy here in Tesla going into those results. All right. Thanks to Alex Coffey, senior equities contributor here on the network, for breaking down markets and Tesla with us. But coming up after the break, Kevin and I are going to be joined by Megan Brantley from Likefolio for a discussion on Netflix and the sentiment data on the stock moves. The company's seen its stock plunge over 25% in the last 3 months, and they report after the close. Stick around. Fast Markets coming right back.
Stick around. I want to average into it here, but that's probably pretty irresponsible. Was that your reasoning for getting puts today? Bond auction at 1. Yeah, that last one was pretty far outside the expectations. So maybe it's going to be a catalyst for it to rip. Yeah, 20-year bond auction. That's right, at 1 o'clock. I got a straight. Cool. Nah. Of course. Why not go all in on 2 re-raises with a 2-9? Oh, ace 3. Well done. High card. Oh, that other guy bailed.
And password share, but I think that just long term it is a positive indicator and supports the concept of pricing power for Netflix, that amid all of these changes sentiment was only hit by 1 point.
Megan, with all the competition in this space, it seems like some of them have fallen back a little bit. Disney's pulling back on a lot of their content creation. Warner Brothers Discovery has been under pressure. I don't know how Max is doing. I think sentiment's probably pretty positive on that, but being first to the market here in Netflix, all the content that they already have on there, I do agree with you. Live sports is probably a detriment to them in the long term. But when you look at like an earnings score on a stock like this, which is a leader, you've seen the pullback and the average revenue per user continues to move higher. Is that give you some solace that hey, maybe they could surprise because maybe they're not spending money on content right now because of the strike?
Yeah, I think that's definitely a potential positive point for Netflix. I think another thing that could be received really well is if they, raise prices or announce that they're raising prices. That will be really well received. We don't know that yet. We can just base off what our data suggests. We do see a bit of a pullback in that growth, and so because of that, we're a little bit cautious heading into this report. Our score trends just a little bit bearish, but this is one of those names where we see some long-term tailwinds developing. We think that if anything, maturation of AI can only help Netflix in terms of content creation and also just content
that tapering channel did hold.
Serving up shows and making recommendations better to improve the overall user experience. So there are some definite long-term tailwinds. If we do see a pullback in this name, I think this is one that we would pick up shares at a lower price.
All right, great stuff, great data as always, Megan. Appreciate it. Have a great day.
Thanks, guys. You too.
All right, that's Megan Brantley, Vice President of Research at Likefolio, breaking down the data for us on Netflix. Kevin, they're supposed to add over 6 million paid ad subscribers. Now, the CFO did state last time that their ad-supported tier it's in the slow, early processes of it, but I was on with Oliver Rennick on MTL earlier today with Michael Pachter from Wedbush. He's turned into a bull in this stock after being a bear for years. So he's nailed it over the last couple of years. And he said free cash flow is really supposed to start opening up for this company, and that's going to be a tailwind.
Well, if you remember, they added 5.9 million subscribers last quarter in historically a slow period.
Right.
So if that reignites and they put up a big number there, Street's going to like that.
Yeah.
If they talk about this page sharing feature, Street's going to like that. If they start talk about acceleration of ads, Street's going to like that.
Right.
The stock is oversold right now. It's 28.3 on the RSI.
Whoa, you don't see Netflix with that much at all.
Exactly.
Yeah.
So it's below the 50. It's below the 200, Tom. So there's a lot of momentum on the downside here with potential for a lot of good news. And I think they win in the strike. They continue to win in the strike because that destination, that appointment you can make to watch the TV shows that you used to have to sit down at a certain time every night, people are starting to really like that. Remember, Suits wasn't this popular when it was on TV. Now it's massively popular on Netflix.
It's like The Office. When they had The Office about a year and a half ago, that was their most highly rated watched program.
Yes.
And now it's
a different sample size can watch it whenever they want instead of having to sit down at a certain time. So, Tom, based on all that, and this is a practice trade in paper money, but what happens if your opinion is, I'm really bullish in Netflix, right? Not moderately. We do a lot of range bound. We do a lot of moderately bullish. What if you're really bullish in Netflix? And you look at a 50-day moving average up around 400. You look at the 200-day around 374. So what I looked at here is some way to really leverage it, right, on the upside. So I went out to November 10th and bought the 360-400 call vertical. Like sometimes we do different ones. This is vertical and vertical, but it's November 10th on the call side. And then I went into this week's October 20th expiration and sold the 335, 325 put vertical. So this is a $40 put vertical.
In the market today, dang it.
Selling a $40 call vertical,
suck
selling
again.
a $10 put vertical, but short dated on the put vertical.
Right.
So, and that's trading, I put it in at 850. It looks like right now it's trading way lower, about $1 lower.
Yeah, we've got $8 here on the risk profile in this example.
It's $7.25 now.
Yep, so it has come down as the market's kind of sold off.
stock is down today.
Right, so let's break this one down because it's two different option series and two different spreads that kind of compromises customized example trade that Kevin brought us. Going out to November 10th, weekly series, 23 days till expiration. Buy the 360 call,
20 minutes
sell
for
the
that bond
400
auction.
strike call. Bullish $40 wide call vertical. Against that, to help finance it, you sell the November, what is it, the November or October 20th?
October 335, 325 put vertical.
325 put vertical in the October series, right?
That's this week.
Yep. So you're selling that one, Kev, and that creates a credit on this one. Your price is basically, what, $8 debit on this one, right? Kevin, when you look at this, you see that break even that they've got on there? It's about 368. This is a bullish trade.
Right.
But it's different durations. Walk us through that real quick.
So as long as it doesn't break 335, that by the end of the week, that short put vertical goes off and it's gone by the end of the week. So you don't have the downside risk of that put vertical at the end of the week. Still have risk. There's still risk of the net debit on this spread. So whatever you get the package for is the risk on this spread after this week, Tom. This week, you have that $10 risk in the big put spread, right? So make sure after Friday, you only have the debit risk. Before Friday, you have the move risk below 335, which was in line with the expected move. It's a little closer now. It's not. So, yeah, the example trade here is extremely bullish.
Yeah.
It's about 35 deltas long, and it actually feels more bullish than that even.
Yeah, that break even, though, that we've got up there in the risk profile, a little bit wrong there. It's closer to 342, so let's make that a clear message. But you do have some assignment risk on that short 335 put into expiration over the next 2 days, so keep that in mind. But as a package, if you paid an $8 debit like we've got on there, you're going to have a risk of about $1,800 on that because of the short $10 wide put vertical, and that's below the 325 strike on that one, Kevin. But it's a bullish trade, help financed by a near-term short put vertical on that one. But a good way to look at it where it's still risk defined also.
And the payback, the maximum payback is almost 4 times the debit. So a little more than a single or a double. It's probably almost a triple if you get that right.
Yep, option market pricing in about a plus or minus $27 move. That's 7.5%. At that point, so good look at an example trade there in Netflix. All right,
still holding this tapering channel.
We'll come back. We're going to take a look at Lam Research. The semiconductor equipment maker has rallied over 50% so far this year. Reports earnings after the close. We'll see what type of impact maybe those China restrictions have on this fab maker. All right, Fast Market's coming right back.
Pair of Kings. Didn't do any betting. This dude's got a 4, doesn't he? Yeah, I knew it. Don't know how to you don't know how to raise. Got a queen. Maybe an ace. Ace, yeah. You can't bluff these guys off when they're holding the nuts every hand. And they played super tight. They were like min raising with best hand. Birds up 20%. Pickers down 15. Well, we have to reverse split soon. It'll just change sentiment depending on the bond auction. So if it's outside of expectations, the further outside of expectations it is, the more it could affect the market, either bullish or bearish. The other day we had a pretty big sell-off from it. It's because it was just so far outside of expectations. Day was that? Yeah, I did pretty well that day. I was set up for puts already, not just based on TA. I didn't even actually understand what the catalyst was until later. It definitely seemed like some catalyst. Excuse me. It's not a no-brainer, Babylicious. Two things. One is, since it's already happened, the expectations have changed dramatically. Because they never want to be wrong. So if they're pricing in a, you know, much more bearish number, and it's not, then that will be a catalyst for a rip. Also, even if it is bad, even if they have such bad expectations and it is as bad as their expectations, market gets, after something happens, if it continues to happen, the market kind of gets more used to it and the reaction gets smaller and smaller. So I don't see it as a no-brainer. Go all in with pocket sixes. Great. Jacks, queen 3, 10-8. Nice. 10-8 took it down. This is the way. Oh man. The jack with a good kicker, maybe. They think I have a 7, probably. Yeah, that's good. I'll take their folds. I don't know what they had. I went big on that flop. Had the 7. These guys are playing it tight and smart. Ugh, higher 2 pair, that sucks. Alright, 10 minutes. New low there. The market is kind of waiting on the bond auction, maybe. What? You didn't have a flush? Here? I had a flush.
Lam Research, they make the parts that make the chips.
Right.
They don't make the chips. So yeah, they're one of those. It's like a supplier to Apple, right? It's one of those kind of companies, but those kind of companies can be really profitable.
Yeah, and a lot of volatility recently, but the stock's just off of those 52-week highs that we saw. So I looked at a strategy here, Kevin, that just takes advantage of higher implied volatility. Volatility's risen a little bit on some of the news that we've seen recently. So I looked at a strategy that takes advantage of higher implied volatility going into earnings. Option market's pricing a plus or minus 30, just over $30 move in the shares either way. Now, Kevin, this isn't one of those stocks with 7 billion shares outstanding as far as a float goes. It's got 132 million shares outstanding. That outstanding as far as share float goes. That's not a lot, and it's a $640 stock.
Yeah.
So
we've seen smaller floats than that.
Yeah.
But this is on the way low end of the range.
Especially in the tech space here. So I looked at short iron condor, Kevin, really short-term positioning. If you think this stock's going to remain
Buying low, they
that
broke
one
it
standard
to the
deviation
downside of that
move,
channel.
This type of strategy takes advantage of that over the next 2 days. Selling the 675 call, buying the 680 call on the call side, out of the money, short call, vertical, $5 wide. Then selling the 605 put, buying the 600 strike put, out of the money put vertical, collecting roughly about $1.90 credit on a $5 wide short neutral iron condor. That means your risk is going to be $310 per spread. But look at those break evens, Kev, about 603 on the downside and just below 677 on the upside. So you've got a decent range, and that's out of that one standard deviation move.
The thing about this that spread that's significant is you said the $30 expected move. Well, you've got your strike $70 wide, so you're outside the expected move, and you're still collecting more than that 30 cents per dollar. So what does that tell us? Either it might make a bigger move, or you're getting paid to move your strikes out. You could go further if you wanted to, but that's a real telling point that you moved even $5 past on either side, right?
Yeah.
$60 versus $70, and you're still collecting close to $2 actually in credit.
And Kevin, when you talk about collecting maybe a third of the width of 30 cents per dollar on something like this, where you're collecting a credit, that's just like a guideline, right?
That's a guideline. It means nothing other than at the end of the day, but it's something to think about. You're not selling it way below, or you're not selling it. If you're selling it higher than that, you know you're selling it for higher than the normal. It's absolutely has no basis in anything other than it's kind of an eyeball test for the value of each $5 spread.
Yep, and we always talk about probabilities. Both of these short strikes in here, the 605 put and the 675 call, it's about 80% probability of finishing out of the money. That's kind of what you want.
You've gone outside the move, so there, and you still got paid for the risk. So yeah,
I think that's key there moving forward. Now, Kev, that's a good look at that short iron condor. You got some assignment risk on those short options, the 605 put and 675 call going into expiration. But real quick, Kevin, we're at session lows here today. Yep. Yields continue to be that thorn in the side of the equity market.
Yeah, this is turning into a real heavy day for the markets. And like I said, we were rallying. The stock market feels good, but there's risks out there.
Yep.
And rates is one of them.
Yep. Keep an eye on earnings,
Eyes down
geopolitical.
1.04.
All right, that's going to do it for Kevin and I here today on Fast Market. But stick around right here on the Schwab Network. Next Gen Investing is coming up.
Next Gen I. Everyone has a queen. I just got a full house. He's king. What the heck? I was going for that flush or nothing, huh? Alright, 2 minutes. Probably not going to see much of a reaction from it, is what I'd imagine. Given that's pretty unusual to have a reaction from bond auction. Unless it's, yeah, way outside expectations. But we'll see. Something to get the market out of this chop would be nice. Seconds. And not much reaction. There's a reaction. It was oddly delayed. Well, 1 o'clock. Holy bounce-a-moly. Okay. They liked it. has just clear evidence of the chop today, though, honestly. Had it back here, too. For some more calls, maybe. Moving fast. It's like you can't even catch that. That's crazy. Here's your bond auction reaction. Closing some of these calls. In fact, I'll close all of them. We could still be in a choppy channel, honestly. Yeah, I overtraded today. Hey, Dink. And sir. to spies so choppy. You know, all this jumpiness. Didn't break out of that channel still. Jeez. This one.
Has been on an absolute tear this year and has held on when Alta has not. So we'll be looking more at Alta coming up next. We'll also be revisiting Visa,
Jenny will
looking
make it
at
all
some
better.
technicals in both of those names, as well as some example
Just have
trades.
continuations.
Stick around.
Bye.
Next Gen Investing. We'll be right back.
No. Next Gen I. Alright, see if we can complete the cup on the day. Put us back to high day. First step. Brick. VWAP. Good first step. I don't like trading with so freaking choppy and jumpy though, gosh. Oof. Removal of worthless securities. Did you talk to them? I don't work for TD or Fidelity. I don't have many answers for you. But I thought they weren't worthless. Butterfly? You like butterflies at Fidelity? Closed a couple there. Crazy reaction. Look at that volume that came in with that too. All this liquidity we built all day today in this chop. Bulls could keep it going. Kind of getting up to the resistance. Support from this morning. Around VWAP here. DK is not over. He's waking up a little bit.
Like we came very close. I mean, if you look at this, you might think it did close, but it did not actually. It did not reach the level of 241.67 that would represent the gap being filled. So kind of a curious thing there that we are trending upward here, but we stopped short at an important point there potentially. That's a place we would need to clear in order to keep resuming our upward activity.
So we're so close, but we're not there yet. Now, as far as momentum of this trend, what are you watching?
RSI, our measure of momentum here, we were seeing a little bit of bullish divergence here after we crossed into that oversold area.
How jumpy the market is. This is crazy.
Typically regarded as a sign of further weakness to come. However, it was contrasted by this bearish divergence that we saw. Price was trending downward, making new closing lows. RSI was actually trending upward at the same time and crossing
volatility's got to
out of the
be
oversold area, which
increased.
is a bullish signal in and of itself here. So we had kind of
These short squeezy type moves on SPY.
On our RSI. Sure enough, price did start to go upward then. More recently, crossed above that 50 midline here, so we have a more bullish reading once again on our momentum measure here. However, we still did not cross above that gap. We didn't fill the gap, so that's more important, I think. The stall at resistance trumps the bullish reading that we're getting on momentum. Price is always the more important reading here, so that's something that is worth noting. If you were feeling like more of a risk taker, you could say momentum's improving. I'm going to get bullish ahead of this move, into this kind of resistance zone we have right here. This area where we had one gap and then another gap. So between 241.5, that's a point to watch, especially if momentum continues to improve.
So we do have earnings next Tuesday after the closing bell. So as far as some key price levels you're watching here, break those down for us.
As usual, earnings could change everything. You know, earnings are a major catalyst for really most companies here. So we could see a big move if we do start getting into the situation where we get a big move that kind of breaks through all these resistance levels that I mentioned. These are the 2 points to watch. This area right here that I was just talking about between 241 and 245 or so. If we were to break above those points, I mean the highs near 250 are within striking distance then. So that could be an area to keep an eye on here. But if things don't play out quite as well, the first point to watch is right here, because we've got a confluence. We've got right near the 237 level within a small span. We've got our yellow 21-day and orange 63-day exponential moving averages. We've also got our short-term trend line in effect there. So the area there would be a key point to hold. If that fails, all the way down here is a couple other noteworthy points to watch here. Our volume profile point of control, basically right on top of our purple 252-day exponential moving average, right around 228. So that would kind of be where I would have my eye on for a worst case scenario to the downside.
Right, but I mean, I didn't even realize that they're up around 4% this month. So they've quietly had at least a decent October thus far. Oh, it's only been about 2 weeks, but obviously into that earnings event, something to consider. So now, when trading this name, say you're hoping for that breakout, you believe that this trend can continue, even though it did fail to give the bulls that critical, point that Rick pointed out. Alex, walk us through a more bullish leaning example trade.
Yeah, one thing I would add to that too is we're in that awkward period where earnings are quite close, but we're not quite there yet. And so one reason an investor may elect not to wait up until that earnings event is, say they wanted to be bullish, the stock is a little bit lower today, and they see opportunity to get long into that earnings event type of trade ahead of it because they see a price at a low point right now. And so with that in mind, what I looked at was buying a call calendar, and it's centered around those levels that it's failed at basically every time it's ever tested it, which is around 250. It's basically within a couple dollars of an all-time high. It's where that spike high of recently that Rick had highlighted is as well. And of course, there's some resistance levels along the way that could influence it. But we're looking at selling next Friday, buying the following week's calls in order to create that 250 call calendar for a 50-cent debit. Means $50 in risk, and you can see mountaintop best case scenario is a move to the strike. But in this case, a move higher is likely to be beneficial for this, but you really would prefer a move to 250.
Right, I think really well put here, and I agree. We're sort of in that awkward phase because I keep thinking it's like Thursday or Friday this week. It's only Wednesday, so we do still have several trading sessions left ahead of this earnings event. I can imagine is a very interesting chart because it has pulled back. I mean, it was seeing such a different year, obviously, earlier than 2023 than what has become of this year.
Unfortunately, kind of an ugly chart, you know, not beauty as its namesake here, but we can see just this long rise upward, culminating in the yearly highs. Basically, a total collapse from this point. And notably here, we had this big move downward on earnings, a 13% one-day drop there. And we did recover all the way back up to that point, though. We filled the gap. We made our way all the way back up, only to result in making new lows. We're almost at the yearly lows here, just a few bucks above that point here, but you can see we've got this downward sloping trend line in effect still. Not the cleanest trend line. We had a bit of an upside excursion there. But, you know, once we drop below 407, you can see we bottomed out here several times. Once we dropped below that level, we made our way back up and retested it, ultimately continued lower to our current situation here now. So in terms of the overall trend, you don't have to be, you know, a technician to see that the trend is down here. But
look
our
at this
moving averages
volatility,
can still
man.
help us confirm
This is
that.
crazy.
Look at the price. It's below all three of the moving averages. All three of the moving averages are trending down. They're getting farther spaced apart from each other. Suggests that the trend is still picking up to the downside, not really seeing any signs of turnaround, especially as we're on the precipice here of making even more new lows below our previous lows. So really quite an interesting situation here, down 32% or so from the highs, and not really seeing any slowdown yet so far.
Right, I know we've had these moments of it seeming like the trend was reversing, but it hasn't been able to hold. It's been in a continual downtrend, like you said. So what's the momentum, what's the RSI now behind this downtrend?
This is one of those situations where you could argue that you're seeing bullish divergence here, but it's kind of dangerous. Look at here. You can see that RSI hasn't really gone too far below that 30 threshold of the oversold level here. In fact, usually a dip into that oversold level was the precursor to a small rally here. If you were banking on bullish divergence, you'd have gotten killed in this situation, in this downward trend here. So you always got to be careful. That's why I was saying in our last chart, the price action is the more important thing here. The RSI is the thing you use to confirm when you're seeing a move in price here. The bullish divergence, I mean, like, coupled with the long-term downtrend in the stock here, I would say that's less significant then. You really got to be careful. You don't want to just blindly base decisions on, oh, I'm seeing an indicator do this, so I'm going to put on this position here. The price action is really the most important thing, and it's something that probably trips up a lot of new traders. So just be careful and be aware of what you're doing.
Yeah, I think that's a really good point. Something you've instilled in us so well is to look at multiple technical indicators. Don't just base, obviously, you're trading on one, because that gets any way that you could get burned. I think that speaks true for everything. You know, don't just base your thoughts on one news source or one, way of thinking. But as far as some support and resistance goes, what are you watching here? We're pretty much at 52-week lows. I know we've recovered about 0.8%, but we're at 52-week lows at this point.
Yeah, right on the edge here. And if we do fall lower, there's not a lot of old price action to help gauge where you might find some support. So I used a study that I like doing in this situation called standard deviation channels. Blue line is our linear regression line, our line of best fit based on closing prices. Then we just take standard deviations above and below that to form these channels. Now, you can see here that the -2 channel is quite a drop. It would be coming in around 346 or so. Not saying that will happen if we keep getting lower, but that's where the study shows we might find some support. That's a potential area to watch if things really start to go awry here in this name. As I said, 370, 380, that's our line in the sand right here. That would be the point where we would start making new 52-week lows. To the upside, though, interesting confluence right here. We've got our yellow 21-day EMA, our -1 channel, and our longer-term trend line going across the highs, all coming together near 393. So that's another key point to watch to the upside. Then 407, the point where we bottomed out here several times, that would be a place bulls would probably want to recapture as well.
Yeah, I mean, it's almost for the best, actually, that Alta doesn't have earnings coming up. We have about a month, maybe for some things to sort of stabilize from here. But really great breakdown on both of these names. Rick Ducat, our chart master. So now, when trading this name, Alex, looks a lot different than Visa, obviously. But say you were hoping for some positive momentum. You were following Deutsche Bank and you were saying, hey, risk and reward maybe looks more attractive given the fact that it's been beaten down so badly. So walk us through what you're thinking for a trade.
You know, Jenny, I think that there's a real kind of make or break quarter aspect to this upcoming earnings, and it really could send this stock back towards its a recovery, or it could continue its downside. And as a result, I'm looking to stay ahead of it in this particular trade illustration. Allow that uncertainty to be out and impact a different strategy, not this one. There's still enough time that we can navigate these waters and avoid that altogether. And with that uncertainty that seems to be building under the surface leading into this earnings announcement, maybe, just maybe, Ulta kind of just holds in place or continues kind of on its downward trajectory. Well, this is a strategy that will benefit from sideways trading. And so that's what we're looking for in this one. We're looking for selling the 365, 360 in the November monthlies, collecting around $1.25. That would be 1/4 the width of the strikes. That creates a
what language did I just learn?
Risk reward ratio. You see that there. Risk 375 to make 125. Break even, simply take away $1.25 from 365 and you're left with 360, 375. So break even, a little bit over $10 below the current share price, Jenny. Risk reward 3 to 1, neutral to bullish. But this is just asking for the downtrend to take a pause leading into earnings, and then it can do whatever it wants because we're going to. This will already have been expired before those earnings come out.
Yeah, I could not agree more that I do think this will be a very make or break earnings quarter for a lot of these stocks, Alta included. Of course, we do have some time ahead of that earnings event, though. But coming up next, we will look at an earnings event that is on the horizon. That is Tesla reporting today after the closing bell. Shares are down about 3.7% now on the session into these numbers. We'll discuss more we can expect from the EV maker coming up next.
Hausa language? Another one spoken in Nigeria, Chad, and Sudan?
price activity, right? We're seeing some selling, taking out the lows from yesterday earlier in the week, but not a lot of follow through one way or the other. And as you can see on this a 5-minute candle chart, that we've just kind of worked our way back off those lows and back up to this 43.75 level. Now just below 4,400, that's a level we've been kind of teetering around for a while. On the bullish side of things, you got strong economic data of recent. We're talking jobs, retail sales. Just yesterday, we'd seen a strong run up in a lot of these tech names, right? NVIDIA, one of the talked about names significantly. I mean, there have been others, handful of names that really help support this market into this fall. In the bearish camp, you've got rates, which have been on the rise. You've got crude now recently with the developments in the Middle East. And here you can see, I was talking about that kind of chop type trade on the 5-minute candle chart, and this is playing out as we sort of step our way back. Here's 30-minute candle charts. Look where we are in the middle of the range that we established last week. A pretty good reflection of a balanced market, right? A tug of war. The bulls and the bears are kind of battling this one out, and in many ways this makes a lot of sense, right? That's what the market's job is here to do, is facilitate trade. And so we get in these kind of range bound sideways, not a lot of conviction type moves. It sort of explains that the market's just waiting for that next catalyst. Here you can see in the middle of the range that we established last month in the S&Ps. I just want to show you where we are relative to the 50, the 200-day moving average, kind of pinched in between, also kind of speaking to the lack of conviction. We've seen some divergences between the Russell, which has been some weakness in small caps. Tech's been pretty strong, though, but take one more step back here as we move away from, again, those intraday charts where you see a little chop and can't really gather too much information to this bigger picture. We're talking long-term weekly charts. This goes all the way back to 2008 on the left side of your screen when the S&Ps were trading down around 700, all the way up to recent all-time highs of around 4,800. And it does seem like we're kind of in a range here, right, Jenny? Off the lows from last fall and pretty comfortable just around and, well, just below this 4,400 level.
Yeah, comfortable, that is an interesting way to put it. I hope we can remain comfortable amid some of these major earnings moves. Like Alex and I were saying at the beginning of the show, we could see some volatility, I'm sure, to follow tomorrow these big earnings events today after the closing bell, but we will leave it there. Great breakdown, Ben Lichtenstein, the host of Futures. So now, Alex, before we get to, of course, all things Tesla for our FOMO segment, curious your thoughts.
Should have closed more on the rip.
Into this event.
I think it's all intertwined.
News choppy
right?
today.
Like you have the yield
Hoping we were done with the chop.
To put pressure on the equity market.
Chop can be over, and then it can resume.
Outside factors like geopolitical tensions that have increased
be
volatility.
Over.
We're starting to see
some of
these things that were really commonplace in
this was
last
breaking
year's
out
market
of it.
start to become stories again in 2023. I think we forget, just how volatile 2022 was, and all of these factors from inflation to economic concerns to geopolitical tensions. That was every day in 2022. This last quarter of 2023 is starting to look a little bit more like 2022, and that's led to a lot more equity volatility. And now that we kind of go into earnings season, these names can, seek to, add kind of insult to injury, kind of pour gas on the fire, if you will. Or they can play spoiler for the bears and, stop this selling in its tracks potentially. If you start getting Netflix and Alphabet and Tesla
Look at
and
this.
Apple
This is
and Microsoft,
crazy.
these are all
Oh, we've got a Fed speaker
quarters.
too.
NVIDIA, it's going to be really difficult for this market to go
William
much
still
lower.
speaking?
But if all those are disappointments,
You might be shaking the
it's
market
going to
up.
be look out below in many cases.
Sometimes these
because
days,
of just the
or end up just
way
being a
that those
Fed
names
speaker that
carry.
was
I
saying stuff hawkish or dovish throughout the day.
Specifically when looking at Tesla is we do
That's
only
kind of what this
have
looks
some
like.
of these delivery numbers, so it shouldn't be like a massive
Comprehensive
shock,
exam,
but
oh
I do
boy.
think that, when it comes to Tesla, anything goes. We could obviously see some volatility. I
Hope
actually
it's
saw,
open
and I think
chat.
this is so the importance of news gathering. I saw the headline that said investors have pushed Tesla stock higher amid deteriorating fundamentals for months. And I saw then the same headline that said Tesla shares are higher with increasingly improving fundamentals. The exact same headline, just reversed. So that just goes to show the take that you can make on Tesla. I think that it does have a very polarizing, of course, the bulls versus the bears in Tesla, very, very prominent. But to speak to, say, the more pessimistic fundamental case.
On that real quick, though, Jenny, where is the starting point on this? Because if you go back to the last quarter, so the last fundamental update that we got, Tesla's almost almost 20% below those prices. Tesla is down into this report.
So that was, I was like, if anything, I feel like the fact that we've seen some selling into this report, any sort of improvement in the fundamentals, I think would be read as a positive because we've been underperforming. Yet I thought that was
crazy.
so odd to say deteriorating
Volatility is
fundamentals, but shares
definitely
are
increasing.
up. I mean, we're not really up. Nonetheless, though, their third quarter profit estimates have plunged by nearly 50% this year amid some of their aggressive price cuts. Yet the stock has more than doubled over the past year. So I guess that is the time frame you look at. But again, it depends on the time frame you're looking at on the chart because we have seen some recent weakness. You can't argue with that. I mean, that is just the fact of the matter. They've continued their price cuts for their popular Model 3 and Model Y vehicles across the globe. They've also seen now some murmurings of the Cybertruck, which I think would be any update on that would be welcome today because they've been relatively quiet on that front. It's expected to roll out obviously next fiscal year. But when looking now at their top and bottom line, we're expecting a 13% jump or almost 14% jump with their revenue at around $24.2 billion, which is what the street is expecting. From a profitability standpoint, street is expecting earnings of around 74
I can make it
cents a
out today
share.
unscathed. I should take that opportunity.
30% lower than a year ago in terms of their adjusted net income. Now, the
Not
drop
trying
in
to make a
profitability, I
profit.
think it obviously correlates with the fact that we've seen this pressure on their margins since they began their cost-cutting efforts
Not a day
last
for a
year.
home run.
I've said this probably 100
Day for a
times, I
base
think,
hit.
even this week, but that was the plan. I mean, if investors are coming out and saying, you know, margins, I can't believe this, to me, you haven't been paying attention. Elon Musk has been so transparent on every earnings call at their investor event where he said, I want to prioritize scale and growth over margins this year because he wants to make right now, I think, these cars more accessible for consumers. Less obviously enthusiastic for Tesla shareholders because we've seen some selling as a result, but Teslas are more affordable now. This used to be a luxury car that served a very niche demographic. That is not the case, at least anymore. Another thing to consider is we do already know those deliveries, 435,000 units. That was slightly below consensus. So they're targeting 1.8 million units for this year, meaning in fourth quarter they have to deliver around 500,000 units. So that's also some clarity I think would be welcome is, are they still going to make that target?
So a couple things that I'll add, because I think you did a good job kind of surmising sort of what the picture is going in here. Everything you said describes a sentiment right now that is a negative cloud over this company. That's to the advantage of bulls in Tesla because it doesn't need to be a blowout quarter to be better than these fears and worst case scenarios and margins collapsing. This is actually an advantage. The fact that the bar is not super high is a good thing if you're a bull in Tesla. In the case for the bears, I mean, the stock's down 4% today, so I'm with you. Look, $14 on this stock doesn't seem like a large market maker move or one standard deviation range that's being priced by option prices, but the stock's down $10. We haven't even got these earnings up. The last thing I'll say, Jenny, before we look at a trade illustration is, here's a comparison that you have not heard, I think, because I think I'm making it up on the spot here. The Cybertruck is the Vision Pro. They're both overpriced niche items that are not going to matter in the grand scheme for either one of these companies, but they make way too many headlines.
I'm going to buy a Cybertruck next year. Can you imagine? I would crash that thing in Chicago.
I need somebody to have a Cybertruck that I know because I want to see one. But look, it's better suited for a video game or like a military operation, I think, than the Chicago streets.
The minute I see one of those things on the road, I'm probably going to like actually confront the driver and ask to see the inside of it because I think they're so fascinating. But you're right. That is such a great comparison. They don't really matter because they're not even expected to have a wide rollout. It's just sort of like a novelty car. And again, it excites me, but from a pure interest standpoint, less from a trader or investor standpoint. So when trading this name, Alex,
Buy still coming down, dude.
We've already seen some massive volatility on the sessions. Markets pricing in around a $14 move in either direction as far as the options market and the market maker move. So what are you sort of looking at here when trading this name?
I think with the stock being down into this report, with the
there you have it.
being
You want
negative,
to get to talk to Jenny?
balances
Grab a
the
Cybertruck.
risks a little bit more. Certainly, Tesla can deliver on these fears, and you could see more downside. But it also makes the bar, as I said, much lower for them to clear, and they could surprise to the upside. So I took a more balanced approach and a neutral strategy, looking for this to sort of be a lukewarm, kind of middle-of-the-road report with maybe limited movement altogether. That might be the unthinkable in Tesla. but stranger things have happened. Looking at selling an iron condor in this Friday's expiration, $15 away from 245 on both sides. So looking at selling the 230, 260 strangle, then buying $5 wide wings. If we're able to collect a $1.75 credit, that's roughly 1/3 the width of the strikes. $325 would be the risk on $175 in max profit. With this, Jenny, basically you have a pretty wide window of over $30, basically, $33.50 if we're going to be exact, in which this thing can be profitable. $30 in which it can be at max profit at expiration. These options are anticipated to expire worthless between 230 and 260. Break evens though 228.25 and 261.75. Simply subtract that credit from the short put at 230. Add it to the short call at 260 to get those figures, but risk defined. Look, if Tesla surprises and it moves a multi-standard deviation, reaction in this earnings, the risk going in. There's $325 in risk, but what I always like about the short iron condor is it's dynamic, Jenny. If the stock sells off and we're in that kind of 225, 230 zone, well, the stock sold off and you're now looking for a rally in the stock.
Intraday short squeeze on the SPY.
Long Tesla
and then
into that
back to
weakness.
regular scheduled shorting.
260, 265, you're selling into that strength, you come dynamically short. So it's a naturally contrarian strategy, and it's one that kind of ebbs and flows with the price action of the stock.
Right, and obviously I think utilizes also that 4% move we're seeing today to the downside. I mean, I think this is actually better news than if we were seeing shares up 4%. I'd be like, oh no, we have some big expectations into these numbers, but obviously we'll be keeping those on our radar when they're released later today. Now, coming up next, it's time to revisit the food stocks. We're talking McDonald's with Caroline Woods. Higher on the session, up almost 2% here after some positive analyst news. We'll discuss more coming up next.
Hava, well done, man. 8%. That's impressive you held through all of this. Or is it? What were they up before the auction? %, yeah. Yeah, I just wanted out too when it came up here, but I got greedy and didn't totally exit. Exited some. Not enough. I thought we were breaking out of the chop. Pretty much. Pretty much, yeah. Oh, the flush got there, dang. Did absolutely nothing. Neither did that person. What in the world? Another flush.
About 2%, still negative year to date, down about 3% year to date, but chipping away at those losses today.
You know, Caroline, well, first off, I think that logic of there's, you know, people that like McDonald's and those who are lying, I think that same logic applies to the band Nickelback. But jokes aside, looking at this stock,
I disagree there.
The stock is down 14% from its highs. This is kind of uncharacteristic for McDonald's. I think we kind of associate it kind of like the names like Walmart and others. They just kind of like slowly but steadily execute, manage kind of the highs and the lows pretty well. With this recent volatility, has the street waffled at all in general? Is the sentiment still pretty strong for this name?
It certainly is. 80% of analysts have a buy rating on this name. The median price target is $315, which implies you know, a good amount of upside from here. But I think it's you know, I think staples, if you will. Obviously, you could say McDonald's could be discretionary, but you know, it's in the camp of stocks that haven't actually performed all that well so far this year. It hasn't, you know, ridden the AI wave or the big tech plays. I mean, obviously Chipotle is really the only, when I was kind of doing a breakdown of some of, you know, the competitors that I was thinking in the same camp of McDonald's, Chipotle is really the only stock that has performed impressively year to date, up more than 30%. But if you take a look, Restaurant Brands International, the parent company of Burger King, that is basically flat on the year. Domino's, I know that Jenny's favorite, that's essentially flat on the year. So it's kind of performing in line with some of its competitors. But yes, 80% of analysts do have a buy rating on shares, and they're overall pretty optimistic about some of the other names as well. Chipotle, 75% have a buy. Domino's, 53% have a buy, so not so many there. Restaurant Brands International, 65% have a buy there. So the most bullish on McDonald's, we just haven't necessarily seen that play out in terms of the stock price quite yet. Let's see if the consumer does finally crack, does start to slow down. If we do get this recession that has been forecast for so long, but we seem to be avoiding, some may say that that could actually benefit a company like McDonald's, which has a lower price point.
Gosh, Caroline, I do love Domino's. This is so hitting home right now.
Pocket aces.
I love Domino's, but McDonald's fries, there is nothing like them. I totally agree. And now I'm thinking about a McDonald's ice cream cone as well. So we will have to grab lunch very quickly after this. I think both Alex and I are starving, but we'll leave it there. Great breakdown on all things McDonald's. Caroline Wood, Senior Markets Correspondent for the network. Now coming up next, it's time to look at Spiro Aerosystems. They're up over 22% on a partnership with Boeing. George Tells will have more details on
blasting
that.
Okay, SPY's turning back up now. I think it's Whiskey Wednesday. Pretty sure that's on the table. Bad day. Practicing bad habits. Not good. Almost. It's probably better on these days that I have a red day. So if I can really remember the pain, so I don't reinforce bad habits. Latest info on Lucid. Here, let's go look. Down 8%. And the news. They have delivery numbers. Analysts make bad predictions. I think that delivery numbers, yeah, delivery numbers were not to expectations. I think that's one I have a short on. Oh, there's a straight. Cool. Missed my flush. Okay. Great. Oh, I should check. I didn't mean to check fold. Whoops. Or called. Dang it. Sure they have a straight though, someone. But does someone have a 9 and 11? What? No one had it? The pair with the kicker? In the world. I guess those bets were pretty small. No one's gonna fold on that. Again with the min raise. Everybody calls. All in.
Systems financials, just briefly, going back to 2019, I'll just give you some numbers. And I think there's, the COVID element, of course, perhaps some of the airlines as well. But if you look at their sales in 2019, it was around 7.8 billion. in the last 4 quarters is $5.4 billion. And the company was profitable back in 2019. They generated about $530 million in net income, but unfortunately for the last 4 quarters, they've lost $858 million. So I think the COVID problems have really lingered for Spirit AeroSystems. I also think that airlines, albeit they are increasing prices, the number of routes are actually falling. Their revenues are higher, but Spirit AeroSystems is not, because the total demand for aircraft is increasing, but it's not kept up with pricing for airfare. And I think that's created some problems for Spirit AeroSystems themselves, not to mention, of course, the 737 MAX problems they've had with Boeing.
Yeah, and I mean, obviously this company has had some problems because of just the volatility we've seen on the year. And I feel like it's not the first time we've discussed Spirit Aero EV pattern for this stock, but we will leave it there. Great breakdown on what's driving shares, of course, higher on the session. George Tillis, Senior Markets Correspondent for the network. That also does it for Alex and myself for Next Gen Investing for this Wednesday. Coming up next, we have the Watch List with Nicole Petalides.
SPY's waking back up again. Weird and volatile today. Up on 2 o'clock. We can make it back to VWAP. See if we can break VWAP, man. Do it. Actually break it, not head and shoulders on it. Put a deposit down. Yeah, they don't have enough. They can't risk someone going out and wrecking it. I think think people, you can get a ride in them if they're, I've seen them like tour around and people take rides in them. But yeah, maybe they won't let you drive unless they paid a big deposit or something. A bigger one, I don't know. I didn't know you meant on the actual cars themselves. Probably good to try and get your deposit back though. Yeah, I'm gonna close more VWAP this time. If we get there. Peace. The price action today is not favorable for traders. Whew. And half of this day has been gnarly. Oh, that's a nice flop. Oh, he's the only guy out there? Dang. Feel bad. Spy. Arr. GME, AMC, like, I don't know what, this other stuff, like, doing the same kind of thing. Microsoft, Apple. I guess Microsoft is a little bit. Apple is too. Crazy. Whipsaw Wednesday. You like them apples? Thank you for letting me know about that. That's great. Straight. Ace 9, what are you doing?
today, but we remain constructive, but we would like to see rates stabilize. We're bullish that rates will, but there's really no sign in the market so far on that.
Right, and when we see rates, I mean, we talk about 5% really, and you see yields, you know, bond yields surging. What did you think about that? I mean, you also saw this quick trajectory in how that happened. You know, the robust September retail sales number made people think that the Fed's likely, or at least has the okay, to maybe raise once more.
Well, we definitely think we're not as focused as most people are on the budget deficit in the U.S. because keep in mind it's the global bond market. So it's really ultra tight global monetary policy. Really, the led by the ECB, they really kicked off this big sell-off in bonds by sucking $500 billion out of their capital markets in a week, and then, you know, continued ambiguous conversations coming out of the Fed. So we think that's the key driver. We are optimistic that'll turn around, although it may not happen anytime soon, because Europe is heading into a recession. Looks like it's going to be about a 2% annualized rate this quarter. And we do think U.S. growth will slow down in response to these higher rates. There will be a lag, but we think the housing market, auto market will slow down, and we'll go closer to slow growth, kind of 0 to say 2 versus this 5%. So we think rates are peaking, but we're cautious in the short run because there's no real catalyst to get them from this kind of momentum sell-off that's going on.
Right. You know, in the Fed Beige Book, they talked about the economy being stable to slightly weaker, but that consumer spending was mixed. I mean, you've heard some of the Fed speakers coming out and saying that they thought the high rate environment was slowing things down enough that maybe they could consider not raising rates again. Just before we get to some, you know,
closing some there.
Ways to move forward, just a final thought here on the Fed, what the Fed will or will not do.
We don't think they will raise rates, although they don't probably know that yet. They need to get more evidence. I mean, really, if you look at real-time inflation, it's about 1.3%. We have that on our website. They don't seem to want to acknowledge that shelter is completely distorted. But they're also going to see this weakness in Europe over the next month. We think we'll have a decelerating growth in this quarter. So if they skip in November, then they should figure it out by December that we really don't need to raise rates anymore.
We're actually going to continue here, Spy?
So in the environment we're in, I know you're looking at Europe and talking about a recessionary environment there, and you could talk a little bit about that. China seems that you're a little more bullish when it comes to China. I mean, what do you tell investors? And you can elaborate on these ideas. I know you have
just freeze. Are you kidding me?
But what do you tell investors?
Oh my gosh.
What should they be doing with their portfolio here?
Well, we do think it's a risky time, unfortunately. You would have thought that it would have cleared up by now, but you can't predict wars and this surprising spike in rates.
Gosh.
So we would be relatively cautious.
Today.
We had thought tech was going to outperform this quarter, but if we're continuing this environment, that could be of concern. So we would be focused on yield securities, primarily preferred stocks.
Dude.
A lot of them,
okay, 10 after 2.
Flagship fund is converting to floating.
Retested VWAP,
which means
big red candles
double-digit income.
Dude, the VIX has got to be ripping.
In case we do have rates going higher, we don't think it will. So we'd be more conservative, large cap dividend stocks.
What is the VIX now?
To ride the tech momentum.
Yeah, VIX is up 4%.
The war, there's some clarity on the war, and at least rates stop skyrocketing every day.
Yeah, understood. I mean, as the tensions go on and
I
things
should just start getting some those
you
February
know,
puts.
high rates and
Those volatilities make me think might dump.
Everything's higher.
Or short squeeze, I guess. But
is this more a regular level, or do you consider this a high rate environment? Because
a rally we've been having, let's see.
4.9% for the first time since 2007.
Might be more bearish.
Are we just normalizing rates, and this is where we should be, or do you see
I can't even exit fast enough up there.
Well, we have a non-consensus view that we're way overshooting to the upside. We think inflation, even if you're bearish about inflation, run rate inflation is 2%. So you're getting a 3% real rate. And so what's likely to occur, there's $52 trillion in global pension assets.
Nice.
They're going to start allocating more to bonds, about 28% bonds. And also, we already just talked about the fact Europe is weakening. So we expect the ECB
Dude, these
to start
pings off VWAP are
lowering rates in the first
crazy.
quarter. And I would watch, as your key indicator, Italy. Their bonds are blowing out. They're 80 basis points above Greek bonds. They have a huge budget deficit, high debt to GDP. So there could be an Italian exit scare that might force the ECB's hand. So there are catalysts, but it's probably not going to be like this week.
Yeah, and I'm curious to see the next jobs report because the Fed within the Beige Book talked about hiring, and obviously we've had a tight labor market, but said that firms were hiring less urgently. And so we'll see what the picture is going forward. Jay Hatfield, nice to see you. Thank you so much.
Great. Thanks, Nicole. It's great
See you. Thank you so much.
Thank you, Jay.
Take a spade.
Coming up next, some investing ideas in defense stocks, energy, AI. We'll be right back here on the watch list. Stay with us.
Yes. Do it. Put me all in. Too aggressive.
I remember when I
King.
first started flying. And we
Didn't even have the spade. Guess that makes sense. I checked one down. Started raising with the king. Wow. Felt some hands. But other people are also. The re-raise. Whip. All in. No. Not buying it. You're man enough to fold? Jack, you're not. Not man enough to fold. Hard to fold when your bluff has been called. Or 30 Fugazi puts? Yeah, make another little head and shoulders here. There is still some pattern to this madness. Stuck in this channel, it's made a higher low here. See if it continues to respect this channel. Huge range. As far as how much volatility is in here. It's just hits the hot highs so quickly. I literally don't even have time to get out of stuff. I have it on 2 different accounts. I'm not trying to like fully exit in case it just keeps rallying, but it just never does. So small exits, and then by the time you're exiting more, you're back. You're crazy.
Treasury side competition on the cap rates for real estate. But right now, currently, the market's still fixed on earnings. We're in earnings season. We're looking at growth, revisions, guidance, and valuation. Currently, 84%, even though we're early on with some of the banks and everything else, 84% of S&P 500 that have already reported have exceeded expectations. Valuations are still hanging in there, about 18 on the PE, on a forward PE, which is lower than the 5-year sort of average there. Not too many revisions. And the growth is actually there. We just saw growth in banks as well. So earnings is the story of the day, even though the 10-year Treasury and all of the yield curve has basically continues to move and march higher.
Tell me a little bit about some of the things you like and why they stand out to you. For example, you have PPA, the Invesco Aerospace and Defense ETF. Is this a good group right now?
We believe absolutely. We've actually had this in our portfolio for our clients for quite some time. And the reality is it's a geopolitical hedge. PPA is a broad diversification by way of investing in defense contractors, by way of the top 10 U.S. defense names. Think Lockheed Martin and Raytheon. And so right now, we have 2 wars. We're looking at Israel as well as the Ukraine. The defense contractors have one thing that Washington, dysfunctional Washington, can agree upon, which is both aid from both sides of the aisle. So we're going to see a lot more follow the money if you go through it, and it's going to follow its way to the defense contractors. So we use this as a geopolitical hedge. It's sort of a tactical asset allocation. Investors should consider this if they don't already have exposure to defense in their portfolios.
Understood. And how about energy? I mean, we've seen bond yields running up. Energy is running up too. Right now, oil's at $88 a barrel, and the likelihood that it could go higher, especially with the wars you're talking about, it's a possibility, right? ETF of XLE, right? Is the name you're watching?
XLE is another broad-based approach to basically entertaining, adding energy into your portfolio. Again, let's look at it. Whether energy is at 88 today, we believe it's going to get it to 100 because tensions will persist. Traditionally, things get worse than they get better. At the same time, energy's under-owned and under-allocated, even in a weighting perspective in the S&P 500. It's already corrected earlier this year, so the valuations are there, and the growth rates are there too. So, you know, oil companies can make money at 70. We don't need $80 a barrel for them to continue to make money. So it's a strong sort of wind in its sail, again, a geopolitical hedge as well.
Right, and most of the people I speak with say the path of least resistance here is to that $100 versus downward at this time. Last but not least, AI is still it. Even in this earnings season next week, we'll start to really kick off and see a lot of the Magnificent Seven and things like that. But for example, Alphabet, Google is a name you like.
We like Google. Out of, let's say, the Magnificent Seven, it's one of the best sort of valuations, but it has AI as a play. Now, the cloud over Google right now happens to be the DOJ is coming after them. They want to break them up, some of the parts. Google wins either way. Whether they're broken up, they'll have sort of more valuation. Investors and analysts believe that's where you're going to see if that goes down the road. We don't believe Google's going to be broken up. All Google has to say in court is, listen, we're the best and we're going to be the best, but our second largest competitor to this is Bing as a search engine, which is Microsoft. The number one searched item on Bing is Google. So you go to Bing, you go type Google, you go back to Google, then you do your
That's
search.
hilarious. I didn't know that.
So I think they've got their case right there. They're great value right now, especially if you look long into the future.
What do you think of earnings season thus far? I know we're just in the beginning of it. This week, for example, we have 10% of the S&P 500. Next week, 40% of the S&P 500 will report. What are some of your takeaways thus far?
you're going to want to look at what the executives are actually saying. What's the impact on the U.S. consumer? Because at the end of the day, 75% of the U.S. economy is the U.S. consumer. So obviously some companies have the ability to navigate and pull some levers to sort of cost cutting. But ultimately, we want to know the pulse of the consumer. Are these long variable rates, lagging effects hurting the consumer? We believe they are. So we believe autos as well as housing is going to slow down and already feel it. We believe real-time data is going to show that. And that's what the earnings is going to come out and say. So I'd be keen to see how the consumer's holding up, because it's probably not going to hold up too much longer. So we're also defensively positioned in terms of adding treasuries to our client portfolios right now as well, even though we believe earnings will actually be better than expected.
But you do think it is going to impact the consumer. You mentioned autos, housing, some of these things that could see the slowing. Robert Schein, great to see you, and thank you for all of that. We really appreciate it. Blanky Schein Wealth Management. Thank you, Robert. Coming up next, time to talk Tesla. All right, is it the king of EVs? Well, certainly leads the way, got that big head start, but now what? We'll get you ready for the earnings report, which is due out later today. We'll be right back. You are watching Schwab Network.
$230. Five. King. Pocket nine. All that, but gave away a lot. Pre-flop all in.
GM, right? We've seen the sales. You talked about quality versus safety. I mean, I think ideally everybody hopes for both. Where do you see Tesla headed? I mean, it has been a big picture winner over time. It certainly has a lot of competition now, right? You have BYD in China. Everybody talks about that. Here at home, you have obviously the big three have been in talks with the UAW and other competitors, Audi, Mercedes, and more.
You know, competition is good. Competition is good for Tesla. I think that what we may have seen in the last few years with these quality and obviously how safety issues is that Tesla maybe was just not really focused on producing the best product out there because it didn't have this much competition in the market. Now, with increasing competition and increasing pressure, I'm hoping that Tesla will start focusing on solving some of its quality issues.
Okay, so at this point now, let me turn your attention, before I get to the supercharging network that they're working on, what about the Cybertruck? People are getting tired of waiting for the Cybertruck and more details.
Yeah, Cybertruck is a little bit like infrastructure week for Tesla. You know, I'm looking forward to it. I hope that it at least meets or exceeds expectations. But also difficult things are hard to get right. And we see the same thing with other tech companies like Apple, for instance. We waited for the AR glasses for many, many years, and we're disappointed every year that they didn't come out. So eventually we'll get there. I'm not in a hurry. If it takes Tesla a few more years to perfect it, then so be it. That's just how long it needs to take.
Yeah. Let's turn your attention over to the supercharging network that you'll be able to charge any car, not just Teslas, and we've already seen them making deals for this. There's competition in that space as well, but this could be good. But it's my understanding it's not going to boost numbers in a big way for the company.
Actually, I think the supercharger is a really good story for Tesla. They're looking at a 10 to 20 billion opportunity by 2030. BMW just announced that by 2025 they hope to have the NACS, which is the North American Charging Standard, which initially was Tesla's proprietary charging plug and has now become kind of like the standard. So, and what we've seen is a steady stream of major car manufacturers switching to the standard. Ford and GM just did. We also have Rivian, Mercedes-Benz, Volvo, Nissan, Polestar, Jaguar, Kia, Hyundai. Everybody's kind of switching to this new system. So I think it's one thing that Tesla is doing very well.
What do you think about all the price changes? You know, I mean, they lowered prices, I know at least 6 times. I don't know if it's all in the same vehicle, but we've certainly seen a lot of back and forth. And what's with the price and concerns about how this could affect the bottom line and looking at margins?
Yeah.
You know, is it that there's not enough demand, or is it that they're just trying to have higher volume out there? What's behind this, and what are your thoughts on it?
Yes, all of those things. Demand has been fluctuating. Obviously, Tesla is, you know, love it or hate it. There are still a lot more options now out there increasingly. So it's not so much EV equals Tesla anymore. Now it's EV and Tesla is just one of many choices. So I think Tesla is just trying to figure out how to land in these tumultuous political and economic times where buying power of consumers is not what it used to be necessarily. They have options. And sometimes price points do need to be adjusted to kind of test the market and see where consumers are.
What about AI? Is Tesla an AI play? I mean, Kathy
Am I waking back up to VWAP again?
Elon Musk himself will tell you so. He talks about full self-driving. He talks about vehicles that go around in Texas and California for days without a person operating those vehicles. Where do they stand as an AI play and self-driving autonomous vehicles?
Yeah, I mean, obviously, Elon sort of, you know, set the moonshot for automotive excellence when it comes to self-driving. every automaker, I think, today is an AI company, just like I think that every tech company today is or has to be an AI company. But AI isn't limited to simply just the autonomous driving. There are a lot of other systems in the vehicle that leverage AI. So whether it's entertainment or communications or productivity or diagnostics, all of those things are going to require AI increasingly. And so, yes, absolutely, AI is a huge component of the Tesla story moving forward.
Yeah. Olivier
Dude, everybody's
Blanchard,
going like,
thank you so much. Of Futrim Group, good luck and preview of Tesla for us. We truly appreciate
flush got
it.
there.
Thank you. Still
Great.
ahead in the second half of our show, let's turn our attention straight over to the real estate sector.
Fold.
What kind of opportunities could there be in that space? Well, our next guest will explain. And a quick programming reminder. Be sure, tune in for next week's coverage live from the Charles Schwab Impact Conference, Wednesday and Thursday. And you will see your favorite market makers, CEOs, all kinds of folks talking finance. And that will be live from Philadelphia.
Do it. These guys don't have enough chips. That why they... Oh, pocket aces, well done. Going to a table with fewer chips so you can just see cards a lot easier. Always go all in. I want to see the advantage of that. That's interesting. These guys are all leaving. They're like, this guy's getting crazy hands. My turn. Getting trashed for so long. $230. If we get a power hour rip. Maybe just to move back to VWAP. I think VWAP wouldn't save me on the day, but definitely help.
400 points, and the Russell is 1.5% lower. Want to get a market update? Ben Lichtenstein is with us, senior futures contributor. What are you watching? 90 minutes left in the trading day. I will say there was also a bond auction that actually went well, where we saw lured some strong demand versus last week, where it was lackluster at best. What are you watching for this 90 minutes of trading, the final hour?
Well, you mentioned the move in rates, and I think that's definitely what's weighing on the indices. All four of the majors in negative territory, led by the Russell, which has been coming under pressure and leading the way. We actually have the NASDAQ, which broke down below 15,000 today, so it's basically right back to the 50-day moving average. And again, all four of the majors just coming under pressure. Investors really struggling to shrug off this higher rate environment with some of the geopolitical tensions that we're seeing. We do have earnings coming up, though. 20 S&P 500 companies reporting today in all.
Yeah, that's true.
So,
after hours, going to be crazy.
We could tip the scales in favor of the bulls here still today.
Might
I think,
hang out after
or later
hours.
this afternoon,
I'm still holding these.
As we hear from Netflix, Tesla, a couple big names on our radar. But also, don't forget jobless claims tomorrow. We'll hear from Philly Fed as well, and Jerome Powell. But yeah, Nicole, I think the focus is definitely on rates, and you can see there we're kind of in the middle of the range here, as I've been saying for a while, around this 4,400 level. Well, now just below that, but basically in a range since June. We're talking 46 down to 42, and starting to roll over here as we retest the middle of it. That doesn't necessarily bode well for the bulls, especially considering some of the headwinds I just mentioned.
Right, understood. Yeah, do you want to elaborate anything on those rates that you're watching most specifically?
Yeah, for sure. I mean, I think what really caught everyone's attention, for one, the new highs for the year, because you know, there's been a fair amount of
sixes, not bad.
To that brief pullback that we saw. A lot of people were chalking up to maybe a safe haven type buying of old school Treasury futures, but it was short-lived, right? And that was one of the things we had been talking about, is in a trend environment to the upside, which are very well defined in one right now in terms of yields. You're going to get a step back, but it's always followed up by 2 forward, and you can see that off the lows we saw earlier this spring, back in April, May, and the move up and through to, well, clearly now knocking on the door of 5% here in this 10-year yield. Also noticing the short end starting to accelerate to the upside, the U.S. dollar, all of this, again, mix in with some uncertainty in terms of what's going on in Washington, a lot of unease and tension in the Middle East here. It's tough for investors to stomach it all amidst, again, this higher rate environment. So we're seeing that in the indices, and rates are continuing higher here, Nicole.
Right. Yeah. All right, Ben Lichtenstein, thank you for that. We're going to continue our chat here about rates, market, real estate sector. Thank you for all of that. Ben Lichtenstein, and our next guest knows all about this. Scott Crow is with us, Chief Investment Strategist at Center Square Investment Management. Thank you for being with us. So as you look at what's going on here, I mean, you are concerned in this high rate environment about the consumer. And I will tell you that we just got the Fed Beige Book and talked about consumer spending mixed.
Right, the Beige Book came out at 2.
What do you say?
Not about that.
Well, look, the consumer
Not much of a catalyst today.
Stubbornly strong.
Not much reaction from it.
In the face of one of the most aggressive rate hiking cycles we've seen in modern history. And that's for a few reasons. Number one, a lot of excess savings from the pandemic. Number two, continued government spending. And number three, the fact that most people's mortgage rate hasn't actually changed, right? I mean, you think about it, the marginal mortgage rate's 8%, but in-place cost of finance is still pretty low. It takes a while for monetary policy, particularly such an aggressive change in monetary policy, to really hit the real economy. So this is not unlike other hiking cycles where you're waiting and waiting and waiting for the data to soften, and it doesn't seem to until it does.
Right.
And we think we're on the cusp of that coming into 2024.
In which case, it sounds like you don't think the Fed should be raising rates.
I don't think they should be raising rates. I think they're done. They should be done. Inflation, the big thing that changed over the last month, in our opinion, which really matters to real estate, because real estate is driven by interest rate costs, is that the Fed came out with this higher for longer. What does that really mean? Well, they shifted the goalposts a little bit. The market could see that inflation was coming down, would be getting within target by the beginning of next year, and hence the Fed would be cutting interest rates. Now, the Fed actually, if you look at their forecast, agrees with that opinion, but what they did was say, you know what, we're going to keep interest rates high for the whole of 2024.
Awesome
because
hands
they're
that
actually
already folded.
worried about the strength of the labor market, because without having the labor market soften, they can't get that inflation genie permanently back in the bottle.
Right.
Said differently, there's tail risk into 2024 that I think is almost deliberate, that they keep interest rates high because they want to cause unemployment to go up. And the only way to do that is to have some kind of recession.
Right. And I mean, they did say that right now that jobs, when it comes to jobs, we had a very tight labor market, that hiring seemed to be less urgent. So I don't know. We'll have to see. We know that we have a very tight labor market. We'll see. And consumers are depleting those savings without a doubt. And then, but you got great retail sales, and so that might help GDP. So we'll have to wait and see. In the meantime, let's focus on some of the real estate ideas you brought to us today. There's certain parts that seem to do better than others. I mean, what's the big picture statement on real estate?
Well, the big picture statement on real estate is we are going through a very painful repricing, right? As bond yields have gone from 1.5% to 5%. Cap rates or yields on real estate are going from 4 to 6%.
All right, see if SPY finds support in this channel
really
again.
If you look at the REIT market, it was driven that lower. The REIT market's implying about a 25% decline in commercial real estate values, which is probably overdoing it a little bit. But the private market is now catching up. So we are going to see a meaningful correction in commercial real estate values, number one. Mostly, though, driven by that discount rate, that increase in cap rate. Because the thing that we do know is that supply-demand fundamentals across most major property types are in balance. In other words, cash flows aren't going to go down that much. So once we get through this interest rate hiking cycle, we've probably done most of the damage to valuations. With that being said, it does really depend on the sector that you're looking at.
Within real estate, right? I mean, there are certain, when we talk about office space, people don't love that, but they do love things that have medical or senior living or things like. Tell us what's working in real estate now.
Everyone loves talking about office, and office is on the cusp of really, frankly, unraveling. Similar to retail prior to COVID, and I think this interest rate environment is going to be the catalyst that really sees a reckoning in the office market. All that being said, there are a couple of other places within real estate where there's
too. I could have gotten both all in.
Really?
One of those is data centers. Data centers, is the physical manifestation of the internet, right? It's where it all happens. Cloud computing is growing at 20% per annum, and now you have artificial intelligence adding huge amounts of demand to the data center space, just at a point in time where the biggest constraint to new data center construction is actually power supply, and that infrastructure is very, very limited.
Right.
And so what you're seeing is very strong levels of rent growth in the data center space, and there's a little bull market going on there, for instance.
Bull market. I mean, that's pretty amazing. We were showing some of the data center names right there as we speak. Senior housing, and then shopping centers.
Yeah.
Considering getting some more calls here, but
there's a quiet bull market going on in
kind
retail,
of my
which is probably surprising people
trading strategy, just in the range.
A lot of that has to do with the fact that we haven't really built any retail since the financial crisis back in 2007.
It's not a good
back
day
then, retail was, was overbuilt, and since then, on a per capita basis, we actually have less retail than we did then. We've had actual negative supply in the retail space. So it may surprise listeners to hear that retail actually has the lowest vacancy rate across all property types in the US.
Right, wow.
And part of that is being driven by the fact that you have more people working from home. So particularly in the suburbs, particularly service-based retail, you've had this step up in demand. And the last thing I would say is, because retail had been so unpopular in the institutional real estate world, you really hadn't seen valuations grow that much and cap rates compress that much.
Yeah.
And so from a valuation standpoint, they've still got a positive spread to debt costs, unlike some other sectors that were hot, like industrial, warehouse, and apartments.
It's amazing, because when we talk about office and you have a lot of those loans coming due, and now, as you noted, right, when you go from 1% to 5% or 6%, housing just in general for folks, they're seeing mortgage rates 7.5%, right? What do you think about the housing market overall, just for consumers?
Yeah, really interesting. The mortgage rates just hit 8% today,
right?
Yeah,
8%. I have a note on that.
Yeah, so what's happening in the housing market, though, is that in a given year, about 90% of all the supply is existing housing being sold and bought. And so what's happened, because the average American has a 3.8% mortgage cost, no one's moving.
Right.
So that's halved. And the home builders, which are the 10% of the market, just can't keep up with demand.
Somewhat bluffing, I think.
Even though to buy is so expensive now, there's this underlying demographic sort of
Very
somewhat
nice.
price inelastic push that just happens every year in terms of people needing to, buy a home for demographic and family reasons. As a consequence, nominal house prices are very, very sticky, and it's just very expensive to own a home.
Right, and as you said, if you have a rate that's really low, no one's going to move.
No one's
and you
moving
do have
anywhere.
a backlog now of some houses that are, in the pipeline.
Yeah.
Right. All right. Thank you so much. It's great to see you, Scott Crow. Thanks for being on the show today. Center Square Investment Management. Thank you. Still ahead, we'll bring in our panel to talk all about Netflix. The streaming giant's earnings are due out after the closing bell. You'll want to hear more about this. We'll get you ready. Watch this.
Yeah, I added my calls there. Did it.
Young lady who was mid.
GME down 0.8. Hit 1381 today. AMC 919 down 6.7. Got 12 minutes to power hour. And drop PH? Oh, power hour? During power hour? Really? If it holds here, this is the support. Has basically been making a wedge. Bullish formation, but can go either way. Right? Has to break the descending side of it for confirmation, but we're showing buyers are stepping in here and sellers are lower and lower. What if we do flush here? Guess it would be pretty bearish on the daily chop. This range. Here's a little flushy. this happened with the bond auction. Closed my calls, and then we ripped. I was right back in them. But this isn't with any bond auction, so we'll see.
You need to see here, it becomes confusing.
So if we look at Netflix's tier strategy, there are a couple of different things to highlight. If we think back to before the crackdown on password sharing was launched in Q2 of this year, Netflix had a choppy year and a half or so where subscriber growth was no longer a given, and more work needed to be done in order to make the platform accessible and attractive to as wide an audience as possible. And introducing the ad-supported tier at a lower price point is certainly one great way to bring in more subscribers, while also introducing a new way for Netflix to monetize their business, as we've heard from our experts just how much opportunity there is within an ad tier to grow also the CPM eventually there, the ad load, really have personalization to make that a huge revenue driver for the company. But just back to the other point about these other tiers, it's just trying to cater to as many users as possible and making it easy to show the value of Netflix. It can bring the content, it can bring hits that we know and love like Stranger Things or The Witcher, but what it needs to do is make sure that at the end of the day, it's still an attractive audience or an attractive offering to as broad an audience as possible.
And also even gaming. I mean, there were reports that Netflix was talking to Take-Two about Grand Theft Auto and to try and add to that. Jawad, I know you were watching the strikes. I mean, you had the actors strike, the writers strike, and of course the writers are now settling, but the actors still on, right? What do you think that might also do for Netflix?
Yeah, look, the entire industry would like to get back to the business of making content. That's what they do, and I don't think it's a lot of people thinking that once the writer's strike got done, that these actors would soon follow, but that seems to be hitting some snags, so we will see. I mean, the good thing for Netflix is it has a huge content production engine, and it's a global content production engine. So you have quite a bit of content. Even when COVID hit, they didn't really see a lull in content kind of coming out, new content for about 9-ish months. So we're about 5-6 months into this particular strike, and content started to really slow down. So we haven't really seen a big impact in terms of their ability to get content out. Obviously, if this continues, that does seem to be an issue. Now, one thing I've noticed, just I've been going on to Netflix, is they have a lot more licensed content. And one of the worries a couple of years ago was every other studio would just bring back their own content and they wouldn't license anything to Netflix, and that did happen. But as everyone else is trying to make money, they are looking to license, but that's helping Netflix kind of bridge the gap.
I know that I'm going to jump in here because we have to wrap up. I know Wolf Research is concerned about the growth for this company going forward in the future years overall, the way they're sort of trying to grow the business long term.
GME is not doing too bad, only down 1%. Market's pretty ugly today.
Thank you both. We'll get all the news after the
But yeah, it's not bullish yet.
Thank you very
Might
much.
not be bullish
Great to see you both.
for a while. We don't know.
I'm Nicole Petalides. Keep it right here. Market on Close. It's next.
I was
minutes to power hour. Nothing specifically. I mean, there's no buyers for it right now. The R2K is down. Like this was kind of the catalyst for letter, but it's just been in a downtrend. It's like it's not. There's just not buyers that want it at this price. Not enough. I mean, the market's like, it's not bullish right now. So you're not getting a squeeze on the Russell or small caps. You have gotten bounced on there. You've seen some of it in GME, but besides that, it's yeah. One minute. We'll spy, find safety. VWAP. It goes on to 0. There's 3 o'clock on a Wednesday. You're low on SPY. Highs coming down some more.
Still have a good is bad situation to deal with, which we were confronted with face on this week after retail sales smashed expectations. The Fed commentary we're getting in the background is still generally very calm, collected, and one can only describe as dovish at this point when they don't feel the need to hike. But you're starting to see other signs of weariness in the market. Look at gold today, for example. Gold's catching a bid. That only really happens either if you're getting a big move lower in yields, which we're not, of course. Usually yields going up means gold's going to get hammered. But gold's now kind of catching a little bit of that safety trade amid the geopolitical situation. You put gold next to crude, which is up again today, and suddenly you do see some of that Middle East geopolitics filtering through the market. Perhaps not the dominant force, I don't think, but still one that is clearly having an impact. It's the only way to explain gold up 1.5%, getting close to 2,000, while real yields, the absolute nemesis of gold, are moving in the opposite direction. That's a pretty powerful move in gold to be able to do that while bonds are selling off the way they are. The TLT is down 1% today, so your long bonds are indeed getting hit. Nothing really new there to say. Cat's out of the bag. Pandora's box has been opened. Fresh new highs. It's anyone's guess where the bond market can go. Though we did see today investors receive the sale by the Treasury of the 20-year bond with a fair amount of confidence, and so we didn't get any additional selling from the Treasury auction today, and we got a little bit of a rough one just in the past week. So that's a little bit encouraging, but generally bonds have broken free, and there's nothing really to say about it until something changes. The only thing really to say is just watch out, because clearly the momentum is in bond bears' favor. Here's a little bit of another issue that's cropped up here right in time for earnings, is that suddenly NVIDIA is looking soft. Second day in a row, NVIDIA is getting hit. Analysts reducing their price expectations now, even though their price targets are still well above where NVIDIA trades. You can't ignore the cuts to those goals because they were all going up and up and up for so long that a few price target cuts do signal a little bit of momentum shift from the sell side and perhaps a bit of fraying confidence as U.S.-China trade relations are still a mess in the semiconductor industry. NVIDIA needs to hold $400, right? Yes, $400. That's where you can see on the chart we've had the higher lows. Very, very crucial technical description because NVIDIA is still uptrending as long as it doesn't break through to lower lows, which would roughly be around $400. So yeah, things kind of falling apart right as earnings begin. Will Tesla come to save the day? Will Elon Musk's price cuts look like a genius competitive move or a forced macro decision out of his control? We'll talk about that and more. Ross Gerber joins us to kick things off there. Danny Kirsch joins us to talk about the housing trade also. And we got Liz Ann Saunders going into the bell, so we are packed today. Let's bring in Caroline Woods and our contributors. Kevin Hanks as well here with me this afternoon. Okay, before we get into some of the earnings, today we've got a bit of a problem with the banks, Caroline. Yesterday we had a big rally. Regionals were having a great session. We're giving it back today. And to some extent, we could blame Morgan Stanley, I guess, for sending the whole sector lower.
Yes, and this is despite a beat on both the top and bottom line for Morgan Stanley, yet shares are off more than 7% right now, down about almost 7.5%. So actually those losses are picking up some steam as we head into this, or as we're in this final hour of trading. Just running through those numbers, Morgan Stanley posted EPS of $1.38. That topped analyst expectations by 11 cents per share. Revenue grew 2% to $13.27 billion. Expectations were for $13.08 billion. So that actually came in better than expected. Trading revenues also came in better than expected, but the wealth management division is what seems to be actually weighing on shares today. That generated $6.4 billion in revenue, which was actually short of estimates because of higher compensation costs. James Gorman on the earnings call said when people have a choice of making 4 or 5% return by doing nothing, they're not going to be trading in the markets. Investment banking, of course, was a weak point. James Gorman said banking has been really weak. That fell 27% in terms of revenue as mergers and acquisitions remain slow. They do expect those to rise next year, so maybe some signs of life next year, but not necessarily pointing to any this year. Net interest income, of course, another key metric, fell 9% from the second quarter. That's expected to continue to fall in the fourth quarter as well. So we're seeing shares under pressure following these results. And as you said, we're seeing weakness across the financials today. Morgan Stanley seeing the steepest decline. But if you take a look, Bank of America off 1.2%, Goldman and Citi both off more than 2%, JP Morgan off more than 1%. So it's really weakness across the board, despite the fact that these banks actually, for the most part, came in better than expected in terms of the headline results. But there's always an asterisk or a caveat, right?
Absolutely. And right now it seems like it's a pretty big one. 7.5% is no game. This is not a test run. This was an earnings season that was supposed to be a bit of a relief to instill some encouragement that things weren't going awful. That being said, Morgan competitively, though, on the trading side, seems like they've lost some ground the last few quarters. And I do wonder if some of this is specific to them, because some of the other stocks have responded pretty well. And actually, you know, like Bank of America we talked about, I know it got hit, but still some of the more lending-focused businesses were able to avoid a big credit event that so many thought was coming. This might be a little bit more of just kind of slowdown in capital markets, losing a little bit of ground to some of the trading peers. Maybe we can dismiss it as Morgan specific. What do you think?
You know, potentially, although I'm just taking a look at some of the year-to-date losses, whereas like a Bank of America is down 18% year-to-date, Morgan Stanley is only down 12.5% year-to-date. I mean, they're all in the red aside from JP Morgan, which is the only. But, you know, really, when you take a look, they're all kind of, you know, Goldman's down 12% year-to-date, Citi down 11%. So, I mean, pretty comparable. I think the big question, each bank has, you know, kind of something looming or a question that still needs to be answered. And I think for Morgan Stanley, it's very much a succession planning type of question. We know that they've narrowed it down to 3 candidates to replace James Gorman. Obviously, there's some uncertainty there, but he made it pretty clear on the call that should happen sooner versus later in the coming months. One specific thing that had stood out to me, he said, overall, this firm is in excellent shape, notwithstanding the geopolitical and market turmoil that we find ourselves in. My hope and expectation is to hand over Morgan Stanley with as clean a slate as possible and deal with a few of our outstanding issues in the next couple of months. So potentially that's a question that could be answered in the coming months, and we'll see what impact that would have on shares.
Yeah, transition leadership to Morgan specific. You know, Kevin, I want you to chime in on this, because it seemed like even though we got a few imperfect results from JP and Bank of America, they were treated with a longer leash than the market is giving to Morgan Stanley right now. And from a macro perspective, too, trading revenues and investment banking being down is kind of more about the lull we had in the capital markets than like some major systemic scare that folks were real paranoid about 6-7 months ago.
Yeah, Oliver, what Morgan Stanley is best at, and it's very in line with what Goldman Sachs is best at, is IPOs and mergers, acquisitions, and raising capital for firms, raising debt. So when they promise, you know, that part of the economic cycle looks like it's starting to pick up slightly. You know,
hey, Kev, I got to jump in because we're losing your audio there a little bit, my man. Sorry about that. Appreciate it, guys, though. We got to keep it going anyway. Caroline Woods, Kevin Hanks, thanks for the thoughts. We got Danny Kirsch standing by, who's been watching the housing trade. So as we move from one interest rate sensitive group to the next, this week we saw also the home builder survey continuing to decline. Though housing was a rock for so long, Danny, head of options at Piper Sandler, you got me a little worried, Danny, when generally your moves have been to fade groups that you bring to us, and housing, if it does fade, I would think could present some serious economic headwinds.
Yeah, I think this year has been a surprise for a lot of people. I think a lot of people expected housing to underperform because rates had already started to move up. A lot of people highlight the 30-year mortgage rate continues to make new highs, but going into the year, I think there was a lot of bears in the space, which made sense, except for the fact that the home builders had like this moat, right? Like the existing home sales have fallen off a cliff, but that's actually a benefit to the new home builders. That being said, like home builders have hung in really well. They've actually outperformed massively. If you look at like XHB or ITB, more than double the S&P year to date. And I think we're getting to that point where these higher rates, specifically on the long end, are going to play a big role. And even though I get that the incremental supplies coming from home builders and they have pricing power. The issue is the consumer is weakening. And this is something we talked about last time we were here. The consumer is already defaulting with low unemployment. We expect unemployment to start picking up. Home builders, and we're really focused on XHB, which is the home builders plus the furniture plus the Lowe's and Home Depot. We think, the stuff you put in your home as well. We think that's where there's a lot of risk.
Okay, so and that part does, I feel like, make sense to me, even within the category of housing, that the houses plus stuff might be a little bit more at risk than just the houses themselves. But hey, look, I mean, ITB, the pure home builder ETF, is coming off pretty consistently from the highs. It seems like since rates broke out, I mean, how much of it is a rates trade? How much of it doesn't need an explosive bond market to be a good short?
Well, I think it's like one of these things. Like, let's say rates come off a ton. All those existing home sales now are your competition. So right now, rates are in a spot where home builders are okay. They're the incremental supply. They're the incremental price. If you look at this chart of XHB, you can see what it's done this year. I mean, like, it has shocked, right? It's up to roughly 30%. We just think XHB specifically, which has less home builder exposure and more exposure to furniture, more exposure to the Lowe's, Home Depot, we think that's where there's downside. And that's a combination of the consumer weakening. We see that home sales have declined, existing home sales are declining, and that is going to continue to play out. And perhaps you get this 10 to 15% pull. And just to be clear, if we sold off 10%,
7.5 call, I'd like to exercise
15% this year. It's not like it's had a bad year. We just think at these levels, even though it's come off from its highs, there's probably more downside to come, especially with the fact that, like, how do you get rates to come down?
You can ask them what they're assuming, but yeah, probably.
Data, right? Is that
it's
good
pretty
for
dumb to
retail?
exercise
Is that
before
good for home probably
expiration.
Not. And I think it's unlikely for the long end of the curve to move significantly lower with the yield curve still inverted. Like, logically, why would you buy the 30-year?
You're just basically forfeiting all that premium that you spent on it
at a higher rate and have more liquidity. Like, I just think that's sort of what's happening. There's a supply-demand dynamic. I think a lot of people are just pushing their bets towards the front end of the curve.
There's not much time left on it, but
on treasuries.
It's a
what's the reason in exercising early?
I'm also thinking about how last year, even though housing came back so strong from the October lows to this October, or rather to the high in July, I should be more specific there, because houses peaked with the S&P again. I guess, it is important to realize that it has traded pretty consistently with the broad market when rates are the problem. Even though it came back to an all-time high, and plenty of other groups did not.
Choppy and just melty and liquidity building everywhere, and then it just rips or
we get a bear
dumps.
market or we get a trend, housing doesn't have some special power.
Sometimes I can do well
right now
these days.
to
Today,
be
not
very
one of
just
those
like
days.
a simpleton
But
correlation
just like
analysis. S&P
so
goes down,
slow for
housing
so
goes
long,
down.
and then has a crazy move in like 5 minutes.
Yeah, and
it's over, and they're waiting another hour.
It's going to act very cyclically, and we think that the part of the reason home builders have hung in so well this year, unemployment is still 3.8, 3.7%. Our firm view is that by December,
no, you're able to
January,
exercise.
unemployment's going to increase significantly.
They were just wondering why you don't want to exercise.
More importantly, the furniture stores, which have a lot of those, have already sold out outside of Williams-Sonoma.
They won't let you exercise?
A lot of them have already sold off.
No, you told me when to exercise, they'll let you.
And there would be a lot more risk to this space that was such a COVID beneficiary. And now, with rates where they are and people sort of stuck in their homes and unable to sell because rates are
AMC.
so much higher, and the people who wanted to buy new homes, they've done that.
That's not.
We just think like
that's not how calls work.
That space has a lot more downside, and it's probably going to look a lot like where the S&P is now by year end. And so what we've been suggesting to clients is buy December
that contract
in XHB
is your right to buy it at that price.
The 70 put for December.
That doesn't go away up until the expiration day.
Crashing, but we do think it's going
so as the stock goes up,
then, $1, $1.50 for that.
You're going to pay the same amount to exercise it.
Ideally, make $10 on the premium you spent.
Got it. All right. So you're owning premium. You're buying downside. Is the liquidity in the XHB options market good for this? I know you obviously track
if it goes below 750,
stuff like that. I mean, is there anything that stands out? Does it look like a good
you
deal
don't want to
from
exercise
an options pricing standpoint right now? I mean, I
That's
guess you
the
wouldn't
point.
be suggesting it if it weren't.
Because you're break even on it, basically the premium you paid.
So skew the level
it's going to be more than 750.
On the money relative to near the money.
It's only going to make sense to exercise it if it's over a certain price by expiration.
And then calls are
probably like $8.
That makes we think the downside somewhat expensive relative to near the money options. So this is why we like put spreads in lieu of owning outright options going out 3 months. I think part of the reason there's been such a big put demand is just to hedge longs. We often hear the argument for why you want to be long home builders. And I would say I'd rather be long ITB than XHB. So that's why we like the short side on XHB in lieu of ITB, because ITB has more of that home builder exposure. And that's, I think, also why you're seeing put open interest so high in ITB, just hedging longs. XHB, we think there is actual alpha can be made on the downside. You're seeing it today. You saw it last week. We think it'll underperform. The S&P down 1.25, XHB down 2.5. Like, we think, expect a lot more of that if rates stay up here into year end and we get Powell speaking.
No, you can exercise it at any time. Doesn't have to be over, under, or expiration date.
To the point where data hanging in isn't necessarily good. I think
whoever you talk to, they just
where rates are
they're
so
just
high
probably
that,
pretty confused because no one exercises before expiration.
Yeah, well, I mean, it's pretty wild stuff, but that's the way it's working.
You're losing
right now.
money.
That was kind of the
doing
point
that.
of the correlation comment. It might seem straightforward if you're watching the market, but it might not be straightforward logically from like a common sense standpoint. Good data, rates go up.
You own the right to those shares
goes down.
at that price on that
I
date.
think, and it's also so short driven. It's so short term, right? Like yesterday, you get really good really good retail data, right?
Mm-hmm.
So you get a pop in all these crowded shorts. They all rally. XRT rallies, and then today, the macro takes over again, and all those shorts that rally, they're all getting crushed again, and it all starts
on expiration. It's not going to have any time value.
Even if you get a little relief,
you're only left
you
with
get some
the intrinsic
data,
value of it. It's over $7.
It's
However,
not a trend,
whatever
right?
it's
You
dollar
get
for
one
dollar,
day
whatever it's over
to make
$7
your
is
money,
what it's
then
going to
you
be
gotta move
worth.
on.
All right.
So
Thanks a lot for the trade details. I think a good way to start off the show.
exercising
here,
early
and,
doesn't make
compliment our
sense.
macro discussion at the
Unless
top
you're
of the
talking about
Steve
like
Kirsch,
getting a dividend or
Edward
something,
Sandler buying the put spread
where you
on
want the
XHB
shares to
for
receive a
December.
dividend.
When we come back, Ross Gerber sets the stage for Tesla. Don't miss it.
Make me wait till after hours for this. I already feel it. The earnings. Tesla kills it.
open-minded. I'm a cyberpunk guy. I'm into the aesthetic. But boy, is there some real unrelenting hate, and there's a lot of other competition that maybe doesn't exist for the sedan market that exists for him for the truck market. So, I mean, is this a kind of new make or break moment for Tesla's brand?
Well, there's a couple of things. Number one, opening up the truck market is a massive opportunity for EV players, period. Okay. And, you know, like I am actually doing construction on my home, and I was listening to the guy before, and, you know, I don't agree with like most of what he's saying because the supply and demand imbalance in housing has never been like this ever. So like everybody's staying in their homes, there's literally sales are down 50%, but like everybody's in their homes is improving them because they can't move. And so when you ask a construction worker what his biggest cost is, it's driving to and from the job every day. So the construction workers at my house lose about 20% of their income to gas prices. So when you look at the possibility for electric truck, and I asked them, would you drive a Cybertruck? And they drive anything that was like a really good truck that was electric because it would save them, you know, $1,000 a month in gas. So, you know, this market is massive and important, and Rivians are too expensive. And the Ford F-150 Lightning is a great car, but they've had trouble selling them. But the Cybertruck, I think, will galvanize an entire new market for EVs.
It's a strong case. I mean, I'm not gonna lie,
dude. The thing is cool. Like, you know, somebody was saying,
"Oh, I am the beholder," I suppose.
No, but like somebody was saying it's like really ugly, and I said, you know, like in my opinion, 80% of the cars on the road are like really ugly.
Sure,
so like what your preferences for a vehicle looks is completely subjective. And so like when you think about something as revolutionary as the design of the Cybertruck, just seeing one will, like I'm telling you, the kids are going to just, like when I had my Model 3 when it first came out and like kids would come around and be like, oh, that's a Tesla. You know, it's like, that's what's going to happen with this times 10.
Okay. I mean, hey, I'm not going to dispute that because it's a taste thing, right? We'll see. We'll see how it goes. We'll see how people like it. What I am a little bit more, I guess, concerned about, or what I would be if I were a Tesla bull, is if Mr. Musk is going to be able to outline and stick with whatever expectations he gives. Are we at the point where he's matured a little bit?
I would call back in and just tell him you want to exercise it.
Live up to
that person just didn't know.
For this, if
probably what they were talking about. You're able to exercise anytime. You say they have a fiduciary duty to let you exercise your shares. They're contractually obligated. That's what that contract is.
Especially with his Twitter venture.
I mean, I could look it up, or you could look it up. I don't think there's any instance where, unless we don't have money to pay for it, you have to have money in your account to pay for it.
This always happens, so we need like a lot of focus right now from Elon. And you know, once again, I think this is a challenging time for Tesla because they've reached some sort of equilibrium in Model Y sales, and they're not goosing sales through any sort of real advertising. And Elon, you know, spends a lot of time talking people out of buying Teslas.
You're not understanding options and contracts.
Behavior. So, you know, Tesla needs to advertise.
Try to explain it. You should just look it up and
educate the market.
Maybe watch some videos on it or something to understand how
need to get this car
what they are.
I mean, it's like the most important
You're not
thing
saving the option by exercising
I
it.
just can't think of anything more important than this vehicle and getting it out in the timeline that he's talked about is by the end of the year, and we're here.
What do you think the market's tolerance will be for earnings?
But you definitely should be able to if you want to exercise it.
The last delivery update that came a little short. I mean,
if
we
you
are
have
expecting
the buying
some
power.
carnage on an annual year-over-year profit change, right?
Yeah, and you know, Tesla's a very expensive stock at 75 times earnings right now, and
all right, Jay.
You know, it's more expensive than Nvidia
out, man.
when you're looking at forward PE, and then you're looking at, you know, potential earnings growth in the next 12 months, according to estimates of like 30% to like $4.50 a share. So any way you extrapolate it out, Tesla's an expensive stock.
There's a gap on SPY.
Don't think the stock can really get going unless people are really like
new low on SPY
and positive about what's happening at Tesla, and that's why Cybertruck. So a lot of it's just sentiment because the valuation doesn't make any sense compared to Microsoft. You know,
30
so
minutes
you look
to
at
close.
Microsoft at 30 times earnings with what they're doing, and Tesla trades at twice the multiple of Microsoft. You know, once again, it's hard to justify Tesla's valuation with earnings not going up.
Sounds like your bullishness at this juncture is a little bit more limited than usual, unless Cybertruck really impresses.
Well, I'm a long-term investor, and I've made 100 times my money in Tesla. You know, I was looking at that. I originally personally bought Tesla in 2013 at
Hey, buddy, don't get any bugs biting you in the grass.
I've taken tremendous amount of gains in Tesla over the years for my clients. So we're comfortable with our position, still a top holding at our firm because of appreciation. But the amount of money we actually have put into Tesla versus gains in our current position is quite small. And so it's a hold for us as an investor. If you're a new client, we're buying Tesla because it's a core position. But the idea that I want to load up on Tesla right now is definitely not what
you got to
do.
call him probably to exercise anyways.
Ross, thanks for the combo.
You just got an
Appreciate it.
automated bot.
Thank you.
Ross Gerber, Kawasaki Wealth and Investment Management. All right, coming up. Got 2 bullish trades in the options corner today, 1 bearish, and across the spectrum. With the huge rally in Spirit Aerosystems, we'll come back to that story as it's a critical component of the Boeing trade as well as the airline capacity build out. We'll be right back.
I remember when I first started flying.
Oh, you actually had something? Dude's been bluffing so much. Pocket queens. You actually had something. Is quite a ways from VWAP now. This would be quite the last 30 minutes. Seen some pretty big volatility today though. Maybe. Okay, yes, if your option's in the money, then the premium, or what you could sell it for, should reflect that, as well as some additional because of theta, which is the time until it expires. I'm saying there's no reason to exercise it early. That you're just burning that theta in case it does come down. Why you have an option is to have the right. That's why you buy an option, have the right to something. You have the right, so you didn't have to put up the capital to own those shares. Now you have that right for however much longer, till what, Friday? Actually, whenever that thing expires. If you're going to forfeit basically your right for the next 3 days and be locked into those shares then. If it goes up, that's fine. You can still exercise for that same price. Because that contract will have more value if it's deeper in the money. 4 aces. Look at this guy. Yeah, even if you're, no matter what, you're going to exercise it, there's no reason not to wait. If it's out of the money, you can still exercise it. It's totally useless, but because you probably have exercise fees too. Like, there's hardly ever even a reason to exercise, honestly. Like, even if you're deep in the money, you could still sell it for the value it's worth and buy the shares. Oh, I thought that was you. That was Guts saying that. GME almost down 2%. 6.25 on AMC.
Like 10 weeks straight, basically.
Yeah.
Wayfair
Gosh, my
has been
computer's
getting
starting to run
slammed for like
slow.
a year and a half straight. Let's go to FedEx first because that sell-off has been very much
Time to format it again.
intense.
Monthly
and,
formatting.
kind of centered on some of their stock-specific labor stuff. But how come the market doesn't give them a break?
Well, I think they have given them a break so far this year. The stock's still up. FedEx is still up 40% this year.
Yeah.
Down 8% so far in October, while the Dow Jones transports are only down about 1 3/4 to 2%. So.
Oh yeah. Sorry, I was
probably looking at UPS.
I'm not explaining it right. You're.
Yeah, UPS has been getting hammered.
There's a disconnect
for
on how.
cost reasons because
My explanation
FedEx in their last
getting
earnings
through.
event highlighted the fact that they're reducing costs by $6 billion by 2027.
Maybe it'll help if you read.
That's going to that'll give
Or
an
just look
improvement
up.
to their profit margins up by
Whatever
12
reason
to
to exercise
13%,
it.
where they're going to compete with UPS
All contract.
better. Remember, this has
Or
been a
when should
roller
I?
coaster in FedEx because in
Or why would I?
2022 and the end of 2021, when FedEx was coming out lowering estimates, they had issues with their TNT acquisition over in Europe. That was just bleeding cash left and right. So the company's done the right things where they've come out and shored up the cost side of their business. They announced another rate hike for package delivery recently. That'll come into play here in the next couple months. And you're heading into what? Holiday shopping season, right? Delivery season for these guys. So that's a bonus.
Bonus.
Earnings are forecasted to grow about 16% in the current year, additional 22% in 2025 due to these cost initiative plans that leadership's put into place. But we did see some longer-term call buyers in here, but it's, you know, kind of putting it out there that this stock's going to rally pretty significantly. Saw some call buyers in the January 280 strike calls. They bought over 10,000 of those. Average debit of $3.25. So that break even, 283.25 over the next 93 days. It's about 16% above the current share price in there. Earnings in December, so we'll get some more clarity on how these efficiency actions that they've taken are coming into play. Call volume is about 3 times normal daily average volume that we've seen over the last 5 trading sessions. So you're seeing some big flows in there. I like the fact that, hey, if you're going to buy some upside calls in here, the stock's still up 40% this year, off 8% this month. If you want to purchase this and you think it's going to go higher, maybe it's going to have a good holiday shopping season, go out to that January option series. You're paying a lot of option premium for a far out of the money call, and you need a big move, but maybe earnings will be that catalyst and maybe a robust holiday shopping season.
Okay. So FedEx still hanging out, very much separated from its peers in the group, and we'll see if that can last through the next couple months.
Yeah.
And with the Amazon also trying to take more control of their supply chain, but yeah, good catch with all that hitting UPS a lot worse than FedEx. How about the Wayfair trade? Had this extreme rally and then an extreme sell-off. Kind of seems like their last earnings basically put the top into the stock. As we heard Danny Kirsch talking about the housing trade, he mentioned some of the furnishing and supply companies that have been getting hit, some of that crossing into retail. But why down 5%? I mean, earnings aren't for 12 days.
Yeah.
Ugly, just melty day. What the heck?
if you see a stagnation in the housing market, kind of equate this to it, Oliver.
Okay.
Let's kind of
so this is basically the Danny Kirsch trade still.
right.
Shop.
If nobody's moving, because nobody's moving from existing home sales, those have been drubbed over the last 8 months. You've got the 30-year fixed mortgage rate hit 8% today, Oliver. That's a headwind for this. New home sales, they look like they topped out about 2 months ago. That kind of stagnated on their last report. So if people aren't moving, that's a detriment to, a furniture maker. And that, along
Good
with
way to accumulate shares is to
student loans
sell cash
restarting,
trade
this
puts.
is, typically for that
Buying
mid to
calls
lower
is
and
like a hedge
consumer that's looking for furniture
to the
at this
upside.
point. So there's some headwinds there. Stock's still up 35% so far this year, even though it's pulled back a little bit. Up recently, Loop Capital just upgraded a couple days ago to a new to a hold from a sell. So price target cut yesterday also, and then
40,
Wells
20
Fargo
minutes to
came out
go.
with
We've
the
got
price
big
target.
earnings
So
after
I think
hours.
some headwinds as far as the consumer goes is probably the reason this stock's selling off here a little bit. But that
It's gotta hurt to be an online retailer and get creamed the day after retail sales shock beat.
Yeah,
that doesn't say a lot about the hopes for your stock.
Yeah, maybe topping out in that going into the fall.
Yeah.
That'll be a concern, I think. And think about it: is furniture a real big seller going into the holiday shopping season? No. If you have to make a choice between buying presents for somebody or buying,
getting a lazy
couch,
boy.
Yeah, probably not a good trade-off. But that being said, we saw some bearish activity in there. Also out in the January monthly cycle, so 3 months till expiration. Trader bought over 6,000 of the 40 strike puts, paid a pretty hefty debit, $470. So paying some option premium, a high option premium. I'm basically an at-the-money put. Break even at 35.30 over the next 93 days. That's 20% below the current share price. Put volume's double.
You're low there
Daily
on
average
SPY.
volume. The 2023 low in this stock, Oliver, 29.5. So it does have that ability to go back down there. But
Still kind of a mega bear trade.
Yeah, somebody betting that over the next 3 months we're going to see some further weakness here in Wayfair.
All right, well, earnings a couple weeks away, as I mentioned, but right now the trend certainly in this trader's favor off the highs. Thanks, Tom. Good eyes on some interesting options action. When we come back, let's take a look at one big winner of the day. It's not in the stock market. There's not many winners in the stock market right now. It's gold.
Really does look like bulls building liquidity, even though it continues to just melt.
Stick around.
Why? Why is it so laggy?
You know that tech stock we talked about?
Happening.
I picked up 500.
SMX up 20%. Oh yeah, there you go. Oh, Weeble. That was weird, just literally crashed, like closed. Freeze or anything. Yep, gonna be waiting until after hours. $15 minutes. Yep, Brad, down 15. Like up 30 this morning. That's OTC now, so be expected. Alright, coming up on 10 minutes. Fugazi, we've got 5.5 minutes. About more an hour ago. Nice. New low there on SPY, flushing down. 15 minutes to go. Wow, SPY's really flushing there. That's crazy.
What you're seeing right now, particularly in the last couple of sessions, is the reaction to what's taking place in the Middle East. And that, again, just you're looking at money flows going into something that is viewed as possibly a safe haven type of structure, at least here for the short term. Let the things kind of work their way out. And if it continues to escalate, Oliver, if the tensions continue to escalate, then you would expect that gold potentially could maintain this upward trajectory. And again, also, what's taking place in D.C. I don't want to discount that. I mean, it's something in the back burner. It probably is not getting highlighted. But if we continue to roll towards, the debt ceiling situation here that was extended with no majority kind of leadership in the House, that's going to be another problem, for possibly the U.S. dollar and other things here in the U.S. moving forward, which again would, in theory, benefit gold.
All right. Dan, thanks for the analysis. Good stuff.
All right, Oliver.
Appreciate it. KKM Financial. Let's get an update on sports streaming with Next Gen host Jenny Horn from the newsroom. All right, Jenny, as you know, I'm not like the biggest sports guy, so talk to me like I'm a golden retriever here, because some of this gets hard to follow.
It does get hard to follow, but I do think it illustrates the fact that we are seeing the streaming and the TV world evolving rather rapidly before our eyes.
Ooh, low there on
years in the
SPY.
making, but as the NBA season does kick off next week on October 24th, it does seem like right now this is the focus here as the NBA has started some of these talks.
If
to
somebody's
secure
earnings
more
will
money
give
for
it a
some of
bounce
its
after
pretty
hours.
hefty salaries as the NBA does enter its biggest media negotiations in nearly a decade. Some of the more legacy players are in focus, those being, of course, Disney's ESPN, as well as Warner Brothers Discovery's TNT, which together pay around $2.6 billion a year, but are not looking to break the bank. Obviously, we know from looking at these stocks, they're in no position right now
Meltdown
to add
action. We
costs
had this
to
the other
their
day,
plate.
too.
So the solution is really being seen as
yesterday?
the league looking to bring in additional parties to the
I had this
negotiating table
meltdown.
as it does work out some of these new deals. They would not be going into effect,
Oh.
obviously, this upcoming season. They'd go into effect the 2024-2025 season. For consumers, though, what this means is it could change significantly where your games are broadcasted.
Yesterday, this.
ESPN
Yeah,
and
just like
TNT do
melted
currently
all
carry
day.
around 165 national televised games
And it
combined,
chopped. We didn't
and they're
get
looking
that
to
chop
explore
today.
some smaller packages
Had the
that
meltdown
would then
after
hang
that.
on to this premier asset being
You
the
get that end of day VWAP
all
chop.
things American media without actually having to spend more money. That again then brings another
10
player
minutes
potentially
Fugazi
into the
coming
space.
in.
Think Amazon, Apple, as well as Alphabet's, YouTube, which is now a pretty major way you can watch all sports. YouTube has emerged as a really powerful streamer, and it's not cheap, but I will say it is very, very much worth it. I think it's the best way to watch sports. But as we also know, Apple does have a pretty major soccer deal. Amazon has an NFL deal. So they are looking to right now enter the arena of negotiations. I think this would be a win for everyone because right now, the way that games are broadcasted, it's difficult to get games out of your area. ESPN's another one that is also in its separate negotiations, looking for a strategic partner to help it transition with its streaming. They've been looking at the NBA and offering this League Pass package, which would then give you the rights to local as well as national games, which is a huge win because again, you want to give your audience as accessible at options as you possibly can.
Yeah.
But what I do know is that this is an expensive deal. We haven't exactly seen numbers from the NBA, but the person who was in charge of TNT's last negotiations back in 2014 said that we could see actually things triple as far as fee goes, meaning we could see a deal worth around $78 billion over the next decade. That's due to some of this heightened interest from a younger audience that really likes the NBA. It still very much dwarfs the NFL, which gets around 17 million viewers per game on average. NBA is around 2 million on average, except for playoffs get around 5 million. So smaller league, but still important. And I think it goes to show really like the takeaway here is some of these companies that you don't think of being sports broadcasters like Alphabet or Apple have deeper pockets. And right now that is what's winning here in terms of viewership and getting these rights.
All right. Yeah, it seems like they got to simplify this process. It's definitely a limiting factor for like an occasional casual watcher like myself. I don't even know where to find these games a lot of times until they put it on Amazon.
That's a huge problem because then you're like the casual viewer. That should be easy. It's like that makes me want to go back to cable.
Right. Yeah, exactly. So that's where I think the NFL Amazon deal, because I saw that a lot. I never clicked on it. And I'm not watching Apple soccer because I'm American and I enjoy real entertainment. Okay, thanks, Jenny. We got to jump. Appreciate it. Thanks very much. All right. When we come back, we're going to the bell with Liz Ann Saunders. Don't miss it. Ahead of earnings season, which truly kicks off with big tech names. Yeah, we got the banks under our belt. Those are important, but we got the giants coming up this afternoon. next week, live from Schwab's Impact Conference in Philadelphia. Don't miss coverage coming live from the event from myself and Nicole Pedalides, as we'll be there. And if, of course, you're around Philly or you're going to be there, make sure you drop by and say hello. Some of the best conversations every year happen here, so don't miss it. It's going to be live here on the Schwab Network. You might even catch a little Liz Ann Saunders joining us as well, who is with us right now to take us into the bell on a busy afternoon and a heck of a day here. Liz Ann, stocks, they kind of feel like they're falling apart here the last week. They're getting hit from a lot of different angles. Nvidia getting hit, rates blowing out. What's the biggest story in your mind from the past week?
Well, obviously, geopolitical events and the uncertainty that wields, not to mention the fact that, at least on an intraday basis, you had Brent crude hit up to 93 and change. And the late September high, which, of course, was before the conflict began, was 94. So I think that will continue to be a big part of the conversation. But given that we're in earnings season, albeit early in earnings season, what's, I think, interesting and somewhat in keeping with what we saw in the second quarter is overall you've had a decent beat rate and percent by which companies have beaten, but the performance of stocks in the first full trading day after releases, even for what they call double beats, companies that beat on both top line and bottom line, have been flat versus a 1% up average over the past 5 years. And then the double misses, which of course is missing on both the top line and bottom line, those on average are down more than 4% versus negative 3 and change in the last 5 years. So even the beats are underperforming the 5-year average. And it does tell you that there are bigger picture macro concerns at play.
Yeesh, that's kind of like a lose-lose or flat lose, I guess, more specifically. Is that just because valuations compared to the bond market are just now way different than they were a year ago?
Yeah, I think valuations are clearly a problem, and that's the transmission mechanism of higher yields tends to come first, which is putting all else equal downward pressure on some of the more highly valued segments of the market. Not to mention, and I put a chart on this in my most recent report that was published on Monday, that the outlook for earnings, the consensus for next year and the year after for 12% earnings growth. I don't think that's realistic because I don't think analysts have really done much with earnings estimates a year out, 2 years out. That said, if you look at the history of Treasury yield moves and then look at periods where you've had at least 12% 2-year earnings growth, there's a complete disconnect there. The conditions from a Treasury yield perspective that have allowed for that kind of strength over a 2-year period for earnings has been declining Treasury yields to the tune of at least 50 basis points. That's obviously not the environment that we have been in. So either it's completely different this time or something has to give, either a quick reversal in Treasury yields or probably some ratcheting down of estimates in the out years.
That's a really interesting metric there to put that in perspective. How does it, because I kind of think like not just pre-COVID, but also like kind of pre-08, the way that Treasury yields often correlated with higher stock prices with economic growth. I mean, that seems, does that vibe with that stat, or how should we think about that?
Well, so for much of the Great Moderation period, which in this case, I'm talking about the period from the mid-90s or so, maybe mid to late 90s, through up to 2020, call it, until the pandemic, with the exception of a brief period in 2008, bond yields and stock prices were inversely correlated. And that was because that was an era of almost consistent disinflation. So as an example, when yields were rising in that Great Moderation era, it was more often than not because of growth improving without that attendant risk of inflation igniting. That's nirvana for equities, and vice versa. When yields were coming down in that era, it was typically because of growth deterioration, even if inflation was contained. Not great for the equity market. You go back to the 30 years from the mid-60s to the mid-90s, and with very few exceptions, the entire period, you had a, a positive correlation between, an inverse correlation between bond yields and stock prices, because that was an era of more inflation volatility. So as an example, in that 30-year span, typically when yields were rising, it was reflecting inflation reigniting. And even if growth was picking up, that inflation reigniting part was more of a
All right, see if
detriment
these
to
earnings
equities.
drop
Conversely,
the first
during
15 minutes.
that 30 years when yields were coming down, it was typically because inflation was easing. Great backdrop for equities. We're now back in negative correlation territory, as anyone paying attention to both markets knows. And I think it's another example of an era, secular era that we're in or transitioning into that looks decidedly different from the Great Moderation era. And it's just something that investors need to consider.
30
A very different
seconds to
backdrop. It's not
close.
without opportunities.
Sure.
It's just very different.
Well, that's so important, and why I love that historical context, because a lot of, I mean, right now we've been getting higher yields oftentimes on days of good economic data, surprising amount of growth or resilience or whatever, but to then take that and say, well, you know, we're going to go back to trade like that moderation period doesn't really work when you got more like inflationary components to the other historical period before that, in which things are inverted. Can you give us a 30, 60-second thought on earnings, what you're looking for generally as from the particularly the sectors that have been leading us, Lizanne?
Sure. Well, if you look at the Magnificent Seven, the expected earnings growth is about 36% year over year, and that's in contrast to only 2% growth expected for the overall S&P. And if you X out those seven, then you're down in negative territory, ex S&P. So I think it's not a stretch to say that handful of stocks probably needs to do pretty well relative to those lofty expectations to provide support for the index overall, given their dominance in terms of market cap, which is higher than the earnings weight. Another reason why you're sort of in a show me moment here.
Understood. All right, thanks, Lizanne. Great stuff. Taking us into the bell there.
Gonna move back to VWAP after hours. It'd be hilarious.
Yeah, see you next week in Philadelphia. All right, hopefully see you guys too. But we've got some earnings to hit. Caroline Woods and George Tiller's going to help us get through some of the reports this afternoon, which include Netflix and Tesla. Netflix, I think, coming out first here. Hey, good afternoon. Long time no see, Caroline. I guess same to you too, GT, since this morning. All right.
Oh, Netflix is out.
Netflix dropped 2.7%, by the way, coming into this. It's now reclaiming quite a bit of lost ground from the last four sessions. We're at 375 right now in the aftermarket, which puts us back to where we were exactly a week ago. Company reported just shy of $2 billion of free cash flow, added 8.76 million new subscribers in the third quarter to a total global streaming paid membership count of 247 million. They also raised their free cash flow forecast to $6.5 billion from $5 billion. So there's a little bingo from the conversation we had with Michael Pachter at Wedbush earlier this morning. He said, Caroline, that free cash flow was crucial at this juncture and that it should be revised higher. And it looks like we just got that. I think that's a real key component of this earnings.
Yeah, we certainly got that. We got the beat on both the top and bottom line with Q3 EPS of $3.73 on revenue of $8.54
selling off a little
billion.
bit.
So that's just a slight beat. The expectation was for 8.53,
Tesla's out, yeah.
but an uptick from the year ago period's 7.84 billion. In terms of subscriber growth, I was seeing estimates of paid net adds of around 6 million, so that 8.76 million, definitely good news there. You mentioned the overall memberships at 247. I was seeing expectations for around 244 million, so that came in at least 3 million higher than expected there. So no surprise that we're seeing shares bounce on this news. Keep in mind, Netflix has really been trending downward since early September, so expectations potentially were lowered heading into this. I know we've seen some price target cuts heading into this report. I do think we want to see some progress on the ad subscription plan and this new pricing strategy. They had gotten rid of their lowest tier in terms of pricing. I will say I did see a headline here from the earnings statement saying that cancellations were lower than expected. So I guess people are holding on to their Netflix memberships despite the fact that maybe they actually have to pay for them now. I still haven't crossed over, but now that it's almost Christmas movie season, I might have to cave and start paying for Netflix. But no, overall seems like a good report. I'm seeing shares higher.
It looks like Netflix is out, but I don't know.
You know, it's a overall. I don't see anything that's necessarily a red flag at this point.
No, it's kind of a success story. I mean, that they were so easily able to rev up and juice subscriber growth again by limiting the password sharing. I think we all had our own skepticisms, and clearly Caroline is an example here that how well that was going to work. George, so I mean, here's the thing though, is that that's different from an organic growth of like market displacement and what made Netflix the extreme growth engine the decade prior, basically, to the post-COVID period in which they actually did see a few quarters there where subscribers were flat to down. So is this a trick that only works for a couple of quarters, George?
I think it's an excellent point, actually, OJ, because if you look at even the estimates for earnings for next quarter, I mean, they are guiding at $2.15, which is in line compared to estimates. Ideally speaking, if this was a multiple quarter phenomenon,
I don't think Tesla's out yet.
I suggest we probably see a little bit higher guidance from the standpoint of forward earnings estimates, at least for next quarter. I haven't looked at the full year, but it looks like it's in line relative to the estimates. And I think, you know, the previous talk about the free cash flow guidance and that being sort of a critical metric for Netflix, I think that's indicative of the transmission towards net income margins, which have improved. Because again, getting people to pay who are, you know, on the fringe or at the margin of not, I think that's important because it's a very cheap way for them to earn profits. And again, is that played out? I would say perhaps in the past few quarters they've generated some good yield from that. But again, going forward, it really comes down to, are they going to grow their growth organically? And I think this is what analysts will be looking for in terms of their conference call guidance.
Okay, you know that. Conference call, I feel like, is going to be so financially focused on the impact of their password crackdown that it might leave some might leave some desires unfilled for strategy, though. And that's kind of the point I'll harp on again, Caroline, which is that we've heard a lot about what they want to do with games, how they're going to deal with original content on the strikes that to some degree are coming to conclusion, but not fully. I mean, there's a lot of strategic things here, too, they still have to answer to.
And Netflix has said that they're still really in the infancy stages of that, and they shouldn't expect to see a big revenue impact until at least the end of this year. So they could be kind of kicking the can down the road, but I think that's a good point. We had the 150-day or almost 150-day writers' strike, the ongoing actors' strike. So there's certainly headwinds.
We've got 4 minutes on these contracts.
Contend with, and we'll see what they have to say about those on the earnings call. I do think that some of the price target cuts that we've seen heading into this report, last month the median price target was $500 a share, and now it's $460, really have to do with analysts homing in on the growth strategy, to your point. And I think they're certainly going to be looking for more commentary on that on this call. That being said, so far so good. I'm only seeing shares
rip SPY to the high of the day
on this report. So let's see once the earnings.
Seen that with NVIDIA?
How analysts and
investors NVIDIA earnings.
After that.
Okay.
It's crazy.
George, what type of
or Apple, NVIDIA, and Apple, I think.
We
saw like the whole day. Actually,
hold on, because we can kind of speculate on what we think Netflix should do from a strategy standpoint. But we got Tesla earnings coming out here. I think the long story short for Netflix right now is that. The strategy is working, basically, long story short. Okay, let's talk some Tesla shares here. We might come back to Netflix, but Tesla's out. Obviously, Tesla got hammered today. It was down 5%. Total production reached 430,488, but the sales and the earnings both arrived shy of expectations. 66 cents on the EPS versus 73, which was expected. In sales, 23.35 versus 24.38. So they missed by about a solid $1 billion. Earnings and EPS never really have been the mover metric for this stock. So I'm not going to focus too much on that. We'll see when some of the free cash flow details come out in a moment. But the revenue was up still. So, I mean, George, it's kind of a choose your adventure thing. I mean, I could see how bulls and bears could spin this both ways. Because ultimately, given all the questions about the economy, given all the concern about the consumer slowdown, given all the criticism around Elon Musk's involvement with X and Twitter and how that was going to eat away at his ability to be a car-making mastermind, revenue still grew 10% over the past year. So, I mean, that's got to be worth something.
It is, and here's the thing: if you look at the price action, at least so far, because we know how things
Yeah,
can change
Tesla didn't
quickly,
kill it.
OJ,
Dang it.
they're giving Tesla a pass, even considering they missed the estimates by about 7 cents. And if you consider earnings contraction relative to the same quarter last year, it's 37% down.
All right, I'm
They're
out.
getting a pass because if you look at the reasons behind it, and I suggest that this will come to light, they're actually lowering prices. So volumes are growing, but the kicker is why is revenue down? I don't know exactly. This is, again, if it comes from the automotive sales, that might put some pressure on the shares as we move through the afternoon or early morning. But they're giving Tesla a pass on earnings because of their strategy. Their strategy is, of course, to increase production volumes and lower prices, and they're aggressively competing now with the bigger automakers out there. Their total production
Okay, I'm done for the day.
guidance.
Thanks, guys.
is the
Appreciate the
last
support.
quarter
We'll see you
still
on
about 1.8
the
million
Discord.
units for this year. If they uphold that or even increase that,